Ikatan Akuntan Indonesia, akuntan profesional unggul, Indonesia maju. Ikatan Akuntan Indonesia, IAI, telah berkiprah mendukung pembangunan SDM dan transformasi ekonomi Indonesia.
Akuntan memiliki peran penting dalam pembangunan nasional yang berkesinambungan.
Profesi akuntan mendukung upaya peningkatan profesionalisme SDM Indonesia agar bisa optimal berkarya mendukung pembangunan ekonomi yang efisien dan transparan. Melalui Prakarsa 6.1 yang telah ditetapkan sebagai program umum Dewan Pengurus Nasional IAI periode 2018-2022, IAI siap berkarya mengawal perekonomian bangsa ini menuju Indonesia Emas 2045.
Saya sangat mendukung rencana IAI untuk mempercepat program sertifikasi agar para akuntan di negara kita memiliki kreativitas, inovasi, keterampilan, dan memiliki daya saing, dan sekali lagi dalam rangka mendukung pengembangan ekosistem kita yang lebih akuntabel, lebih efisien, goal-oriented, dan inovatif.
Tanggung jawab itu terwujud melalui Chartered Accountant Indonesia sebagai identitas akuntan profesional Indonesia dan telah mendapat pengakuan kualitas secara global. Prakarsa 6.1 berisi 6 langkah aksi dengan satu tujuan strategis untuk memperkuat peran IAI dalam meningkatkan kepercayaan masyarakat terhadap entitas bisnis dan publik dengan menyiapkan akuntan profesional berintegritas siap menghadapi masa depan. IAI melaksanakan tugas dan tanggung jawabnya menyusun standar akuntansi keuangan dan standar profesi, melaksanakan ujian sertifikasi, serta aktivitas keprofesian lain mengacu kepada International Federation of Accountants dan Chartered Accountant Worldwide. IAI for Society dijalankan untuk memberikan manfaat yang semakin besar bagi masyarakat serta untuk mendekatkan profesi kepada publik. Founding Fathers IAI telah menetapkan 2 tujuan pendirian IAI. IAI dibangun untuk mempertinggi mutu pendidikan akuntan dan meningkatkan kualitas pekerjaan akuntan Indonesia. IAI menguasai perubahan, menyiapkan masa depan.
Gabung Brevet Pajak IAI, pilihan tepat untuk Anda. Pelatihan Brevet IAI, ahli pajak, bedah substansi, temukan solusi. Kenapa memilih IAI? Modul yang selalu update dan materi yang dilengkapi dengan pembahasan studi kasus komprehensif. Instruktur yang terjaga kompetensinya, berpengalaman, dan tentu saja profesional. Apa aja yang didapat kalau belajar pajak? Sudah pasti, kita jadi tahu seluk-beluk perhitungan pajak.
Through Initiative 6.1, which has been established as a general program of the IEI Council for the period of 2018-2022. IAI is ready to work and contribute to the safeguarding of the nation economy towards Indonesia Emas 2045.
Saya sangat mendukung rencana IAI untuk mempercepat program sertifikasi agar para akuntan di negara kita memiliki kreativitas, inovasi, keterampilan, dan memiliki daya saing, dan sekali lagi dalam rangka mendukung pengembangan ekosistem kita yang lebih akuntabel, lebih efisien, goal-oriented, dan inovatif.
This responsibility is materialized through the Chartered Accountant or CA Indonesia as the identity for Indonesian professional accountants, and the quality is globally recognized. Initiative 6.1 includes 6 steps of action with one strategic objective to strengthen the role of IAI in increasing public trust in business and public entities by preparing professional accountants with integrity ready to face the future.
Kepada generasi muda akuntan Indonesia yang menjadi peserta di APAFES, saya berharap agar para akuntan muda juga mampu menguasai teknologi. Jangan pernah berhenti belajar. Manfaatkan kesempatan untuk memperdalami dunia keilmuan dan pengalaman berbisnis, sehingga kemampuan kalian dapat terasah.
IAI carries out its duties and
Hi, Professor.
responsibilities
How are you?
while the financial accounting standards and professional standards carry out certification examination as well as other professional activities referring to the International Federation of Accountants and Chartered Accountants worldwide. IAI for Society is run to provide greater benefits for the community and to bring the profession closer to public.
Udah ya? Udah.
IAI's founding fathers have set two goals for the establishment of IAI. The Institute of Indonesia Chartered Accountants, IAI, was organized to enhance the quality of accountants' education and improve the quality of Indonesian accountants' work. IAI, Mastering Change, Preparing for the Future.
Your business is a living thing, growing and evolving based on the decisions you make, the directions you take. Chartered accountants have the breadth of skills, commitment to ethics, and global expertise to help your business thrive. We are uniquely experienced to make a difference to your world. Choose a difference maker. Choose a chartered accountant.
The chairman of Institute of Indonesia Chartered Accountant Tax Accountant Compartment, KAPJIAI, who also the head of East Java First Regional Tax Office DGT Indonesia, Professor John Hutagaol, Managing Director of Bureau van Dijk, a Moody's Analytic Company, Mr. Kisodial, IAI National Council Member, KAPJIAI Council Members, IAI Executive Director, our colleague from ASEAN Federation of Accountants, the honorable speakers and moderators, all the distinguished guests, participants, ladies and gentlemen. Good afternoon and welcome to the second day of Virtual International Tax Conference 2021, the new era of global tax transparency. Ladies and gentlemen, my name is Monica Nabilia and I'll be your host for today. Ladies and gentlemen, this year is the 8th collaboration between KAPJ IAI and Bureau van Dijk, a Moody's analytic company, in hosting the International Tax Conference. To deliver the opening speech, we would like to kindly invite Mr. Kisodial, the Managing Director of Bureau van Dijk, a Moody's analytics company. Good afternoon, Mr. Kisodial. How are you?
I'm doing well. Thank you very much. And how are you, Monica?
I'm good. So I think the screen is yours now.
Okay. Thank you very much. So good afternoon, everyone, ladies and gentlemen. On behalf of Moody's Analytics and the Indonesia Institute of Chartered Accountants, IAI, I would like to extend a warm welcome to everyone in this virtual room for the second day of the International Tax Conference 2021. I'm very excited, and we as Moody's Analytics, to co-host this event with IAI, as Monica said, for the 8th consecutive year now. Despite being another year where we cannot host this event in person, so we need to do it remotely via Zoom, the number of delegates present in this conference, not only today, but also yesterday, is impressive. And this speaks loudly about the interest, relevance, and success of this conference. So before moving any further, I could not proceed without express my sincere gratitude and appreciation to Professor John Utagaul, Chairman of Tax Accountants Compartment of IAI, and all the work he does in order to make this event possible, as well as all the IAI members that work behind the scenes to make this event possible. Also, in advance, gratitude to all honorable speakers and moderators and the National Council members of IAI, as well as all delegates. Welcome. So yesterday, on the first day of this conference, the discussions and presentations were predominantly focused on how Indonesia is handling the economic impacts of COVID-19, and in particular, the fiscal policy response to manage these challenges, and looking at it mostly from a budget deficit perspective. As we know, managing such a response is a very delicate balancing exercise and presents many challenges to policymakers. On one hand, expenditure is up as there is need to help businesses and individuals through stimulus and contain the spread of the virus. So much more money being spent, expenditure is up. On the other hand, tax revenue is down due to lower economic activity, business closing, people spending less money, so lower consumer spending, and a sharp decline in tourism-related income, which is very important for an economy like Indonesia. With this in mind, we have heard yesterday that the Indonesian government is investing in very efficient and impactful ways to support and accelerate the economic recovery, whilst at the same time bringing a number of tax reforms to make it fairer, but at the same time close the fiscal gap and ensure that the public debt doesn't get out of control. The recovery programs and the harmonized tax laws being rolled out have specific goals and principles in mind. And yesterday, I've learned that we are using the strong acronym for the Indonesia recovery principles. So S for sustainable, T for a tax agenda, R for recovery, O for opportunity, N for new form of technologies, and G for goal-oriented. So essentially, the acceleration of the economic recovery and state revenue optimization are obviously of great importance to manage the deficit and therefore the public debt affordability. It's even more so given all the economic and social programs requiring funding over the next few decades in order to deliver against the Golden Indonesia 2045 vision. Okay. We also heard that Indonesia plans to introduce a carbon tax program, something very exciting and really innovative, and that even many developed countries are not thinking about, but Indonesia is showing the way there, and certainly within developing countries, it's at the forefront of such initiatives. Yesterday, the day was closed with a panel discussion on transfer pricing implementation, which is an area where Moody's Analytics helps dozens of tax authorities and thousands of tax practitioners across the world. We do that by offering a global database with a large set of private company data that helps tax practitioners to research profit patterns and view them against comparable companies. We also offer a comprehensive and detailed global shareholding information for those businesses, which enables tax professionals to get instant visibility into complex and opaque tax structures. And we also offer workflow solutions that increase the efficiency of transfer pricing implementation by speeding up and facilitating the arm's length company data comparison and royalty rates and lending margins analytics. So essentially, as discussed in the panel yesterday, data and technology and fit-for-purpose solutions really increase the efficiency. And I think we as Moody's Analytics play a critical role in that space and help tax professionals and tax investigators alike to make more efficient, better, and faster decisions. So that was yesterday. And for today, we have lined up 3 panel discussions, as well as one presentation from my colleague, Makbul Lalji, who has many, many years, if not decades, of experience with the UK Tax Authority, HMRC, as a tax investigator. And he will be discussing with us how data can address tax risks and the challenges presented by the growing digitization of our economies. The conference will then be closed by my honorable friend, Professor John Hutagao. And sincerely, I really hope that the topics you have chosen for this year are informative, are relevant for you to address your day-to-day real-life challenges as accountants and tax practitioners. So thank you very much. And I will now pass it back to Monica so that we can start the proceedings for today with a panel discussion on the current development of exchange information. Thank you very much. Enjoy, and I hope you find it really exciting and informative. Thank you very much. Monica, back to you.
Thank you very much, Kiso, for a very nice, warm welcome for all of us. Before we move on to the next agenda, I would like to invite you, also Professor John Hutagao, also Bapak Pontas Pane, Pak Edward Tanujaya, Ibu Eli Zarnihusin, to have a group picture. So could you please turn on your camera and smile and hold that smile for a minute, please. So please wait, I'll gather everyone. Yeah, we have Pak Edu. Okay, I'll count to 3. So you smile. 1, 2, and 3. Another one. 1, 2, and 3. Very nice. Thank you, ladies and gentlemen.
Terima kasih.
Sama-sama. Now, moving on to our next agenda. Before we start the panel discussion, please allow me to read the housekeeping rules that apply for this conference. The participant microphone and camera is always on mute position. This webinar is being recorded. IAI will broadcast this on our communication media. For raising a question, please use Q&A function. Materials and recording can be accessible on IAI website or other communication media. Ladies and gentlemen, our first segment today will discuss about the current development of exchange information, On the panel, we have Ibu Sanityas Jukti Prawatyani, the head of Exchange of Information Unit, Directorate International Taxation DGT Indonesia. We also have Dr. Esther Koisin, the Director, Department of International Taxation, Inland Revenue Board of Malaysia. We will also have Ibu Patricia, the Deputy Director, Research and Regulation Department, Indonesia Financial Services Authority. The last but not least, we have also Ibu Ratna Febrina, partner SF Consulting, member of CROW. This panel will be led by Ibu Christine Chen, the tax expert from Universitas Indonesia. So girls power. Ladies, welcome. Before we commence this session, please allow me to read a brief CV of Ibu Christine. Christine Chen is a lecturer at Department of Accounting, Faculty of Economics, Universitas Indonesia. Prior to become a lecturer, she joined KPMG Jakarta at Tax Consulting Division. Christine is a tax expert who has involved in several research projects and trainings related to Indonesia taxation. She is also active involved in KAPJ IAI. Before I hand over the session to Ibu Christine, I would like to once again remind all of participants to use Q&A function to raising your question. Please to also state it to who the question is being asked. Okay, ladies and gentlemen, now I will hand over the session to Ibu Christine. Ibu Christine, the screen is yours.
Thank you, Ms. Monica. Good afternoon, ladies and gentlemen. How are you today? I wish you all be happy and healthy. The Honorable Professor John Hutagao, the Chairman of IAI Tax Accountant Compartment, Mr. Pontas Pane, the Vice Chairman of IAI Tax Accountant Compartment, and Mr. Kisodial, Managing Director, Bureau van Dijk, our distinguished speakers, and all participants of today's webinar. I hope today's webinar is very exciting for you all. So it is an honor for me to become the moderator of this panel discussion session 3 of Virtual International Tax Conference 2021. Ladies and gentlemen, if we are talking about taxation, tax avoidance, and tax evasion, there is an increase in the need for transparency and exchange of information globally. Therefore, today we will discuss a very interesting topic with regards to the current development of the exchange of information. This topic will be delivered by our prominent speakers. They will share with us around 15 minutes, and after that, we will continue with question and answer session. And if you have any questions, please type in Q&A function. Ladies and gentlemen, our first speaker is Dr. Esther A.P. Koisin. Hi, how are you, Dr. Esther?
Hi, Christine. I'm good and very pleased to be here today.
Yeah, so happy to have you here today, Dr. Esther. But firstly, I would like to read Dr. Esther's CV. Dr. Esther is the current director of the Department of International Taxation, Inland Revenue Board of Malaysia. Her department deals with the international affairs, exchange of information, tax treaties, transfer pricing, advance pricing agreement, and mutual agreement procedure. Dr. Esther has a doctorate degree in management from the University Utara Malaysia, economics degree from University Malaya, and law degree from the University of London. Without further ado, I would like to invite Dr. Esther to share with us her presentation. Dr. Esther, the floor is yours.
Thank you, Christine. And let me just put the screen, my presentation on the screen. Firstly, thank you to my old friend, the Mr. John Hutagao especially, and also the Institute of Chartered Accountant Indonesia and Bureau van Dijk for inviting me and the Inland Revenue Board of Malaysia to be part of this very important conference. And I wish to congratulate the organizers. I noticed that this is the 8th consecutive year in which you have successfully organized this program. So today, this topic, I'm very pleased to join my colleague from Pajak especially, and also other fellow panelists in this session. This is a very important for me. I think this is a very important topic. It's very relevant, especially to tax administration, to taxpayers, as well as tax professional. And I hope this session, as informative as it can be, it also contribute to voluntary compliance. So I have prepared some slides here. I'm very bad in sticking to slides actually, so please do forgive me if I depart from the slides that I prepared. I do intend to stick to the 15 minutes, but I hope the outline that I have prepared here will help me stick to the time that I have. So my presentation as tax administrator, I would like to share some background of exchange of information, especially the need for exchange of information since 2009 in particular. It's a very important year, and a bit of some information about the various types and how we actually use this information as tax administrators, in particular the Inland Revenue Board of Malaysia, in addressing tax evasion and promoting voluntary compliance. And lastly, I'll like to share some latest development in exchange of information, especially what is happening to the discussion at the OECD level, as I am very much involved in the discussion in the various working groups. For instance, the working group, Working Party 10, the AOI group, and the competent authority meetings, the global forum. We are very much involved in the discussion pertaining to this topic. So I basically would like to share some latest development there. So, we're talking about tax evasion and the need for exchange of information and tax transparency. I think it's the evasion is something which is very much intertwined with taxation. Some colleagues of mine sometimes joke that it is very much difficult to part with money earned, hard-earned money, and sometimes it could be easier to probably leave your wife. This is men talk, but I mean, joke aside, I think sometimes it could be a true reflection of how some tax evasion is happening all over the world, that it is some things which, when the opportunity is there, some taxpayers may take the opportunity to save as much money as possible and try to avoid paying the rightful amount of tax. So in 2009, when the G20 declared that the end of bank secrecy and brought everyone on board to this new cooperation where exchange of information will be key to address tax evasion, Malaysia has come on board, and we have committed to the international standard for transparency and exchange of information on request in 2009. So we know very much that there's very limited resources, and the government really need a lot of the rightful amount of tax to support the development, social development, and economic development of the country. And as tax administrators, the Inland Revenue Board of Malaysia welcome this new development in exchange of information. we have put in place a structure to ensure that we could exchange information with all the treaty partners that we have, and whether we have our own domestic interests in the exchange information or not. We have started to commit to the international standard by exchanging information, although we do not have domestic interest in the information that we exchange. So in 2009, that is really the beginning for a new era for exchange of information. And from there onwards, we have been exchanging information according to the standard of exchange of information on requests. We try to exchange within 90 days. It is really very important that tax administrators will be able to get information to support audit and investigation. You see, when the standard of exchange of information on requests was established, as tax administrators, some auditors are quite skeptical that they would be able to get the information as quickly as they would like to, because you know, getting the information timely is very important for them to really finalize their case. But over time, we were able to actually see the result of this cooperation. And for us as well, not only we were able to provide the information to our exchange partners, but we are also seeing the cooperation from our exchange partners providing us with the information that we requested, those possible relevant information. So we are seeing a very effective exchange of information. And for taxpayers, I think exchange of information and requests, I think it's better transparency and fairness in the tax system. Definitely compliant taxpayers will like to see that there's a level playing field. Not only the good taxpayers are paying their fair share of the tax, but everyone should be also paying their fair share of tax. So exchange of information, which is supporting this the implementation of the tax laws, is seen as promoting fair tax system and also promoting voluntary compliance. So paying the right amount of tax in the right jurisdiction. I think that is really very important for taxpayers as well as to tax administrators. So briefly, I think my colleague from Pajak will also be mentioning the different types of exchange. I can quickly mention that over the last few years, we have seen the three types of exchange of information, which is the exchange of information request, whereby we request the information as we are auditing a case, and we see that cases are possible relevant in our administration of the audit cases, then we can request from our exchange partners. There's also this spontaneous exchange of information. All these are actually in accordance to the legal framework within the DTA or within the multilateral convention that Malaysia is also a signatory to. So there's a cooperation of exchange of information there. So spontaneous exchange, as we have also informed our auditors that while they are auditing any particular cases and they find that there are some information which we think that will be relevant or would be helpful to our exchange partners, without being asked, we will also send that information. So for Malaysia, for instance, we have been receiving information from our exchange partners. For instance, if our taxpayers are purchasing maybe very expensive goods in another country, and they are claiming VAT at the airport or any other places where they purchase all those expensive goods. We will be getting this kind of information. This is your taxpayers. We are spending hundreds of thousands purchasing diamonds or watches or all kind of things, and this information may be useful to you. So we do welcome all this information. We use this information for risk profiling of the taxpayers. We use this information to see whether by using means test, capital statement, whether what they have declared to us, the tax amount of tax they have paid to us is probably reflects the amount of income that they are actually earning. So that kind of information we are getting from our exchange partners as well. So the latest one is, of course, the automatic exchange of information. That is the information from financial accounts, which is kept by our taxpayers in offshore, outside of Malaysia, as well as the country-by-country reporting to see the global situation of income and businesses of multinational. So, well, for us, like I said, we had our first commitment in 2009 for exchange of information on requests according to the standard. And for the financial account automatic, we have our first exchange in 2018. And we have been using all this information for our audit and investigation cases for the CRS information, that is the financial account information. We have a special task force. Sorry, I couldn't see the slide. It's a bit covered there. Maybe I use another computer to just see the slide. We have a task force. We have formed a task force in 2019 when we first received this CRS information. And this task force actually work on analyzing all the information that is received from all our exchange partners. So the automatic exchange of information on financial accounts is very, very helpful. For Malaysia, we get about 2 million of accounts of Malaysians overseas, putting their money overseas, and through the automatic exchange of information, where we are getting about from more than 70 jurisdictions, we can use this information to do risk assessment. So that's how useful it has been, and we have already successfully used this information, and some of the cases has been audited and has contributed a lot of revenue for us. And in 2018 as well, when we were first started to receive the first exchange of information on financial accounts, we have also used this opportunity to tell our taxpayers that come and make a declaration under the Special Voluntary Disclosure Program. We are going to have, we are getting all this information, and if you come voluntarily, penalty can be mitigated. So from that special voluntary disclosure program, we have also managed to collect more than 7 billion Malaysian ringgit. So you see how the development in exchange of information has been really very helpful. I think not only to tax administration, but I think it's also giving opportunity to taxpayers to really organize their tax affairs. So I think we don't have so much time, but I just want to highlight a bit on the latest development, what is being discussed at the OECD level. We are now already having all different kinds of exchanges. We have exchange of information on requests, whereby we can request any possible relevant information on the taxpayer. We already have spontaneous exchange. We have already automatic exchange of information on financial accounts and the country by country reporting. And at the global forum level, we think that with the development in digitalization of the economy, there is something more that we can also benefit from. So there is already a discussion on ensuring that there is a tax transparency for crypto assets and digital money products, whereby probably there is not much information yet being transparent to the tax administration on all these transactions. So with this new requirement to make a reporting on this, there will be more visibility on the income derived by our taxpayers from investment in virtual assets. And as this income generally be taxable in the hands of the investors. And the other one is, of course, the income derived from digital platform. So for this one, I think the framework is already issued out by the OECD on income, whereby the sellers of this using this platform will be the information on the sellers in this sharing and gig economy through the platform operators will be reported to tax administration. So I think overall all information should be made available to transparent to the tax administration. So I think what need to be recognized here is that there is greater cooperation by tax administration throughout the world, and there's lesser room to run away from tax. So I think all taxpayers should take the opportunity to get more taxpayers education and try to comply. And even bilaterally, tax administration is also widening the scope of automatic exchange. I think there is also an ongoing cooperation to finalize a bilateral cooperation between Malaysia and Indonesia. So I think I'll stop here. I think I finished my 15 minutes, and thank you very much for this opportunity. Thank you.
Thank you so much, Dr. Esther, for your clear and brief presentation. And ladies and gentlemen, there are several important points from Dr. Esther's presentation. She has shared with us regarding the exchange of information, Malaysia's experience, that she shared that the first task force is established in 2009, and there are audit and investigation cases, and also special voluntary disclosure program, which conduct from the 3 November 2018 until 30 September 2019, which help the taxpayers to organize their tax affairs. And also, they conduct the risk assessment with the IRBM CRS task force, for example. Thank you so much, Dr. Esther, for your presentation. And our second speaker is Ms. Sanithias Jukti Prawatiani from Digiti Indonesia. But before we listen to her presentation, I will share her CV first. Sanithias Jukti Prawatiani, or Ms. Tias, is currently serves as Head of Exchange of Information Unit, Directorate of International Taxation DGT Indonesia. She earned her Diploma 4 from STAN and her MBA at University of Southern California. And now I invite Ms. Tias to share with us. Ms. Tias, the floor is yours.
Okay, thank you, Ms. Christine, for the opportunity. Good afternoon to the speakers and also to the participants of this virtual seminar, which is conducted by the Institute of Indonesian Chartered Accountant. Pak John, Pak Pontas, and other IAI members. It is a good opportunity for us, Directorate General of Taxes, to present what is the current development of EOI in Indonesia. I hope all of you are doing well. And let me introduce myself. Ms. Christine already mentioned my name. Just call me Tias. Now I'm in a position of the head of EOI unit in Directorate General of Taxes. We have listened to Dr. Esther's presentation. She has delivered her speech regarding the future current development of EOI in Malaysia. My turn is to share with you the development of EOI in Indonesia. I will also talk in about 15 minutes and what we have done so far in the Directorate General of Taxes. And I will be happy also to have a discussion with all of you after all the panelists delivering their speech. Can we move to the second slide, please? Okay. My presentation will be divided into 4 sections. The first one, I will talk about the use of EOI, but it's only at a glance because Dr. Esther already explained to all of you about the use of the EOI. And also, I will talk about the types of EOI, Indonesian practice, and the latest development of EOI in Indonesia. Next, please. Okay. As we know, the cross-border transaction allows taxpayers to transact with their affiliates in overseas to reduce the tax payable. Furthermore, we also knew that bank secrecy also provides shelters to hide flows of illicit funds. In this regard, developing countries have suffered the most. To tackle the tax avoidance practices, global cooperation to exchange information between jurisdictions is needed. So not only that we have cooperated with other jurisdictions in exchanging information, we also have actively involved in the Global Forum on Transparency and Exchange of Information for tax purposes to make sure that the legal framework and the effective implementation of EOI is in place. This is the reason behind why we need to exchange our information with other jurisdictions. Next, please. Now we will see this picture here. Looking for data or information is not an easy job. Domestic information, or we can see here as the above, the surface information, will be easier to be found. Seeing this as an iceberg phenomenon, unfortunately, only a small portion of the information, which is domestic information, as the tip of the iceberg can be seen. Whereas large portion of the information, we call it as information kept in other jurisdiction or below the surface information is hidden. So in order to discover the below the surface information, we need to have exchange of information with other jurisdictions to obtain information related to fulfillment of taxpayer obligation, which at the end of this SIM will prevent tax avoidance, tax evasion, and treaty shopping. So why EOI is needed? I think this is the basic reason for us to look for data or information from other jurisdictions. Next. The legal basis for Indonesia to implement EOI, there are a number of international legal instruments on the basis of which exchanges of information for tax purpose may take place. Among others are the tax treaty or double tax convention, and then tax information exchange agreement or TEA, Convention on Mutual Administrative Assistance, or we can call it as MAC, and then MCAA and BCAA. Under the double tax convention or treaties, Indonesia, up to now, we have exchanged information with other 71 jurisdictions. But among 71 treaties, there are 2 treaties that do not govern the provision of the EOI. Those are Saudi Arabia and Switzerland. By way of TEA, there are 6 jurisdictions that can exchange information with us. Those are Jersey, Guernsey, Isle of Man, Bermuda, Bahama, and San Marino. Using MCAA, there are 2 types of information under the theme of AEOI. The first one is the AEOI on financial information. So far, we have 161 jurisdictions as of July 2021. For AEOI on CBCR or country by country report, there are 90 jurisdictions as of March 12, 2021. For AEOI on financial information that used by BCAA, we have so far signed the agreement with Hong Kong. And then for CBCR, we have signed with 2 jurisdictions, the US and Hong Kong. At this point, we have still in progress of signing the BCAA with Argentina for AEOI on withholding tax, and also with Malaysia. I hope that Dr. Esther, we can proceed our our bilateral CAA regarding the withholding tax using AEOI scheme. Other than international legal framework, we also have a domestic regulation on EOI. For example, law number 9 year of 2017 regarding the financial information access for tax purpose and its implementation regulation. Next, please. Okay. The types of EOI, as Dr. Esther already mentioned, there are 3 types of EOI. The first one is EOI on request, spontaneous EOI, and automatic exchange of information. In general, there are 3 forms of information that can be exchanged under the EOI on request. Those are ownership information, for example, name and address of the entity requested, the tax status of the corporation, and so on. In form of accounting information, we can ask or request income and expenses reported, and then arm's length prices, and so on. And also banking information is a kind of information that also can be requested from other jurisdiction partners. The information that is exchanging in form of spontaneous EOI basically is any information. Any information can be used for future tax purpose, such as unilateral APA, and so on. The spontaneous EOI is the provision of information that is foreseeably relevant to other jurisdiction and that has not been previously requested. Because of the nature, spontaneous EOI relies on the active participation and cooperation of local tax officials, for example, account representatives, tax auditors, and so on. As of January 2021, there were 147 jurisdictions which enter into EOR and spontaneous EOI network. Whilst for AEOI, we already have up to now more than around 100 jurisdictions that has entered into the convention of AEOI. Next. Okay. Now we are talking about the Indonesia practice of exchanging state information. The increase in the use of information from EOI on request is to increase the monitoring of tax compliance. In DGT, these activities is conducted by the account representation. Also, the EOI on request usually is also asked or requested by the auditors to examine the compliance of the taxpayers. But not only that, we also, the auditors can also conduct investigation, and we have several requested to other jurisdictions regarding this matter. In terms of appeal and objection, this year, there are around 3 requested from other jurisdictions that we use for objection and appeal. The EOI network to multilateral agreement and bilateral agreement with other jurisdictions also important for us to widen the exchange of information. And the most information from spontaneous EOI, like I already mentioned before, are in the form of a unilateral APA that can be used for the future assessment. And the last one is financial information that is that are received from AEOI. Now is in DGT is incorporated in tax database, which is processed by the Data and Information Directorate. This one is to assess the tax compliance risk of the taxpayers. Next. Oh, before that, please, the next slide. Okay. In this slide, I would like to explain the EOI SIM, either request and automatic, that is conducted in DigiTax. The request, we can see from the box on the left side, the tax office can request for EOI through International Taxation Directorate as a CA in Indonesia. After that, the International Taxation Directorate can send the request to other CA partner. But of course, the EOI unit has to make sure that the request is under the criteria of the EOI on request. For example, we have to make sure that the allegation is already there, and then the case that is or the information that is requested from other jurisdiction is foreseeably relevant with the case. Also, the request is not fishing expedition, and the local tax office already looking for the data on information domestically. After that, if the criteria has met, then we will send the request to the jurisdiction partner. If the jurisdiction partner are able to provide the information, then International Taxation Directorate will send the information requested by the tax office, and then they will report the utilization of the data to us, to International Taxation Directorate. In the form of AEOI information, the inbound AEOI that received from other jurisdiction is collected by the International Taxation Directorate, and then we will send the data to Data and Information Directorate, where the Data Information Directorate will collect it and then will integrate, also validate the data as part of the data quality assurance functions. And then after that, to make use of the Data and Information Directorate will identify and present the financial information that is collected from the AOI as a data trigger for tax office to conduct clarification, audit, also for preliminary evidence examination, or for objection and appeal in a tax court. Based on the data that we have collected, in 2021, so far we have received data from AEOI. 85 jurisdiction has sent the data to us. Meanwhile, 70 jurisdictions also received AEOI data from Indonesia. In form of EOI or request, there are 16 inbound EOI or requests, whilst outbound is 97. We can say that Indonesia is really, need the information from the other jurisdiction. If we can see here that inbound request is lesser than outbound request. In form of SEOI, the
5 minutes to go, Ibu Tias.
Okay, I will start here. This is the last slide actually, Christine. In form of SEOI, we have sent we have received data from SEOI from 32 jurisdictions, but so far we haven't sent any information in form of SEOI to other jurisdictions. This is the data as of September 30th, 2021. Okay, last slide, please. Okay, the future development of EOI is also similar to Malaysia that Ibu Esther already mentioned before. We are actively participating in a discussion with Global Forum, especially with Working Party 10. The income from personal services and also from rental property, for example, from Airbnb, also has become the model for reporting of the sharing and economy. Not only that, we also participating in the discussion of tax transparency on crypto assets. And also now we are in the middle of discussing the common reporting standard for crypto asset. Domestically, we have also a discussion with BAPEPTI, or the Agency for Commodity Future Trading Regulatory, because in Indonesia, the provider of crypto asset has to report their transaction to BAPEPTI. So we, in the future, we would like to have a cooperation and coordination with the BAPEPTI to also to have this information that can be exchanging to other jurisdictions. That's the future development of the EOI. So as a wrap, I would like to share to you as the conclusion that the three types of information, either automatic, request, or spontaneous, is a tool that is very important for us, for Indonesia, to collect the data and then can be used to enhance the compliance of the taxpayers. And we would like to have more cooperation and also coordination with other jurisdiction partners to receive EOI, to receive data, in a timely manner and an effective way. I think that's it, Bu Christine, my presentation. I would like to have the discussion.
Thank you very much for the comprehensive presentation, Ibu Tias. Ibu Tias has shared with us related to the Indonesia experience. We have heard about Malaysia experience. Now we also heard about the Indonesia experience, that there is an increase in the use of information from exchange of information request, and also widening exchange of information network through multilateral agreement and bilateral agreement with partners jurisdiction. And Ibu Tias also share with us regarding the importance of the exchange of information tools as the tool to collect the data and enhance the compliance of the taxpayers. Thank you so much, Ibu Tias, for the presentation. And we have heard about the exchange of information from the DGT side. Now we will hear the experience from the taxpayers side. So our next speaker, I would like to invite Ms. Ratna Febrina. Okay, Ms. Ratna, current position is partner of SF Consulting. She has over 20 years of experience as a tax consultant with Arthur Andersen and Ernst & Young Indonesia before being a partner in SF Consulting. Prior of being a tax consultant, she was an auditor in Deloitte. She holds bachelor's degree in accounting from Universitas Indonesia and Bachelor of Law from University of 17 Agustus. Over to you, Ibu Ratna.
Yeah, thank you, Christine. Yeah. The Honorable Professor John Hutagao, Chairman of IIA of Tax Accountant Compartment, the Honorable Mr. Pontas Pani, the Vice Chairman of Indonesia Institute of Accountant of Tax Compartment, and the Honorable Mr. Kisudil, Managing Director of BVD Van Dijk, distinguished speakers and distinguished guests. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon. The exchange of information as an application of AOI in Indonesia has started in 2018. So it is now 3 years. Yeah. The previous speakers are from competent authorities, which the presentation discuss AOI from the authority perspective, and as a practitioners, I will discuss AOI from the eye of practitioner. Can I have my presentation? Yeah, next. Yeah, next slide. So back to yeah, back. Okay. So my presentation will consist of 3 parts: the transparency of financial data, implementation of AOI in Indonesia, and the impact and challenges of AOI. So we heard that the presentation from the previous speakers that the transparency of financial data has an important role, yeah, in the tax area. Next slide. The objective of financial data transparency is to reduce tax evasion, so the possibility to evade the tax will reduce, and then to restore tax revenue which is missing from non-compliant taxpayer, to increase transparency and accountability among financial and tax institutions, to increase the disclosure of hidden asset voluntarily, and to encourage taxpayer to report all information that is relevant. This is very important for the taxpayer to report their asset together with the information that is relevant. For example, for the individual taxpayer, if they report their bank account, it's better also to put the number of bank account and also the bank names, and also if the investment in the form of bonds or shares, it will be good if it is also disclose the name of the company of the share that they own, because if there is like a letter from the tax office asking for the clarification of the asset, it will be easier for the taxpayer to trace the asset, whether they have disclosed it or not in their tax return. Next slide. Okay, I will start with the tax amnesty 2016. So the government into 2016 has introduced tax amnesty. The government gave the opportunity to the taxpayer that has not disclosed their asset fully to take this moment to disclose all of its asset without having the sanction. This is actually the transitional period before the enactment of the AEOI. So next slide. Next, yeah. This is the data we get from the DGT performance report for the result of the tax amnesty 2016. From the participation of tax amnesty, we see that mostly the individual that participate in the tax amnesty, 76% of the participation in the tax amnesty is from the individual. With regard to the asset declared, so the total 4,800 trillion, that is 24% from the asset overseas, and then 76% from the asset domestic. So we see from this chart that there are huge amount of the asset that has not been declared. So we will not know that how huge the asset that has not been declared without having this tax amnesty program. So I think we are all aware that the government has launched again the voluntary asset disclosure program, which will be effective in January next year. Next slide. So previously, there is a limitation access from DGT to get the financial data from the financial institution because it needs approval from the Ministry of Finance, and also it took a long process and a long time for the DGT to get those data. And then also with the standard application of AEOI, it requires the data availability, data access, and data exchange. So AEOI can only be applied if financial data available and can be accessed by the DGT. So the government has to have domestic legal framework so that DGT can collect the domestic financial data. So the government has issued the Perpu number 1/2017 as the basis for access to financial information, and then the implementation regulation, MOF regulation number 70 and number 16 regarding the technical guideline, and also law number 9/27 regarding also the technical guideline to access the financial information. Next slide. With the issuance of that regulation, so the financial institution, custodian, and other investment entities have obligation to perform due diligence procedures for account holder for new account, and then they have to register whether they are reporting or non-reporting institution. If they are considered as reporting institution, they have to report financial information to DGT. Next slide. This is the benefit of AEOI. I discuss a little bit regarding the benefit to detect the tax evasion and offshore wealth, because of there are still the offshore wealth that has not been declared by the taxpayer, deterrence from future non-compliance, supporting domestic synergies, because with the transparency of overseas financial data, that data can also use to detect if there are any illicit activities such as money laundering. And then the last one is enhancing reputation, that the reputation of the country will increase if they applying the transparency of the financial data. Next slide. Next. This has been discussed with Ibu Tias and Dr. Esther. Next slide. So the implementation of AOI, I'm focusing the discussion on the individual tax here. So the implementation of AOI, that the information consists of the identity of account holder, account number, and then income related to financial account, identity of financial institution, and also ending balance of financial account. Next slide. So this is the data from the 2018, from the data received from AOI that received by the Indonesian government. So the Indonesian government for the 2018 data received a very huge amount, 6,000 trillion. This is 57% from the domestic financial institution and 43% from the partner jurisdiction. So after the data received and then the data process in the DGT, that from the total 6,000 trillion, around 89% has been clarified and then reported by the taxpayer. So it's clear the amount, the value is 5,000 trillion, and the remaining, the 670 trillion is in the process of clarification by DGT. Next. So this is the long process of identifying the data to the taxpayer. So from the 670 trillion that need clarification, that action taken by DGT, 117, and then has been identified 78 trillion, and 39 is still in the clarification from the DGT. Next slide. Next. So the impact of the AOI is we see that it can be used to optimize tax revenue by prevent tax evasion and also prevent the misuse of the tax treaty. And also by the AOI that the government will receive information either the taxpayers has complied or not with the tax regulation.
5 more minutes, Ibu Ratna.
Yeah, still only another one page, Christine. Next. Yeah, the challenges of AOI. From my previous presentation, we can see that the government received a very huge data, and this data will be analyzed and translated, will be matched to each of the taxpayer. As I mentioned, that this is mostly on the individual taxpayer that I discussed here. That because of the process of the matching of the taxpayers, so the tax ID information is very crucial. Without the tax ID information, that it will be difficult for the authority to match with the local taxpayer. If there is no tax ID, then the other information can be used, such as the address or the date of birth of the account holder. That's consider the huge data and also the complicated process that is done by the content authority. And because of that process, sometimes is when the tax office issue the clarification letter or SP2DK to the taxpayer, data is not belong to the taxpayer, so it is not. There is maybe a mistake in the matching to the taxpayer, and then also there is a mismatch of data between the investment and its financial institution. For example, there is an investment that the SP2DK say that this is from the certain investment institution, but actually this is the amount is correct, but it is not from the investment institution as mentioned in the SP2DK, but it's a different financial institution. And then AOI data need to be clarified to taxpayers. For example, the data exchange related to the overseas income is in the form of gross amount, which is taxable is actually is net amount, so need more data on the related expenses. And then also there are account in the form of joint account. So there are cases that bank account owned by 2 or more individual, so there is a possibility of duplication, and also disbursement of maturity bonds sometimes considered as sales in the data exchange. So this is a mistreatment in data analysis. So, and then the disclosure by the DGT in regard of data to be clarified to the specific taxpayer, it is the same like, for example, the data does not belong to the right taxpayers. So in summary, that the challenge of AOI is due to the very huge data received by the authority and the complicated process to match to each taxpayers. So it needs the cooperation from the tax authority and also the taxpayers in communicating this data. So that the end of my presentation. So I give it back to Christine.
Thank you, Bu Ratna, for interesting presentation regarding the exchange of information. And I think the interesting thing is the last part is regarding the challenges of the AOI. Like you mentioned that there is a quality of data exchange that should be reviewed and clarified, and also the disclosure by DGT in regards of the data to be clarified with the specific taxpayer. So those challenges is the homework for our government to clarify for the data. Okay, so last but not least, our last speaker is Ms. Patricia from Indonesian Financial Services Authority. I would like to introduce her CV first. Patricia started her career at Bank Indonesia and served at Financial Services Authority currently with the current position as Deputy Director. And she was the member of Indonesian Financial Accounting Standard Board, and she is graduated from Universitas Sumatera Utara, majoring in accounting. Ms. Patricia, offer to you 15 minutes. Thank you.
Thank you, Christine. Assalamualaikum warahmatullahi wabarakatuh. Shalom, Om Swastiastu. Salam sehat buat Bapak Ibu semua. I would like to explain a little bit about the regulation in OJK regarding the exchange information. So, participant, let's see some slide of this. Okay, wait. I will share my slide. Yep. Okay. So let me explain that about the exchange information in this kind of process. OJK have role in collecting information from the financial service institution and forward the information to DGP. As you have heard from the explanation from Ibu Tias, the information in there is being reviewed and then being exchanged to another jurisdiction. So there is two regarding the exchange information. Actually, there is a regulation number 25, which issued in 2015 regarding the exchange for information. At that time, only for the CRS purposes. But by the issuing of Perpu number 1 2017 or the law 9 2017, now we already update our OJK regulation in 2019. So I will explain several part that as you have to know that the background of this regulation is the supported from OJK to the process of exchange information. You can see in here as one of the best regulation is the Perpu number 1 2017, and now you can see in here there is a party who should submit the information is the financial service institution, which is comprised of banking, capital market, and the insurance company. So they submit to OJK, and the OJK pass the information to the DGT. Actually, in the regulation, there is two types of parties that would process the data. There is for domestic use and for the international exchange information. The submitted report through OJK is only for the exchange of information and for to give the data for exchange to other jurisdiction. For other purpose, for other institutions, they send the information directly to the DGP as follows. Then I will explain more deeply regarding what is in our regulation. Basically, we regulate 3 sections in this regulation. Is about the obligation to submit reports. So it's articulate about who is the subject of this regulation, what is the information, and then how if the banks or the financial institution do not have the related data. And then the second section is about the submitting procedure. Is more on administrative, like how to connect to like the system itself is called CPNA, and then the appointment of responsible office and responsible officer, and then the deadline of report and the correction of report if any error is found. And last is, because this is an obligation to submit, so in every regulation, since it's an obligation, there is a sanction section. Let's take a look on the parties that should submit the report. Okay, I would go this slide. Yeah. So who should submit the report? First is since OJK supervises financial institution. So the financial institution covered in here is banking. Banking is a commercial banking and rural banking, which operate in a conventional way or based on Sharia principle. The second one is the capital market. So in here we see the securities company and the custodian bank. While for the insurance, for non-bank institution, for insurance is the life insurance company and the general insurance company, including the Sharia principle-based insurance and the insurance product, especially only for the product who has cash or annuity on the contract. And then the next, when the data is collected by the financial service institution, before it's submitted to the exchange of information, FSI map the data based on the customer and then the jurisdiction, and then support the submit the report based on the mapping that is required by the DGT. And regarding the jurisdiction in Buktia's presentation before, it's already said about 76 jurisdiction and about who has a tax treaty with Indonesian government. So not all the customer is sent, but is basically based on the sum of the jurisdiction. So in terms of the financial information that is exchanged, the information include about the identity of the customer, and then number of account, and then the amount of or nominal of the savings, including the revenue from the savings, and also the identity of the reporting FSI. Next, I will go to the slide of here. About this is more on the administrative side, so I just go pass on this slide. Since there is a system called CPNA, Sistem Penyampaian Informasi Nasabah Asing. So since there is a system, there should be a responsible officer who reporting, and then the responsible officer should be appointed formally. And also banks should register to the DGP for additional to register to DGP system. Next, I will explain. Oh, sorry, I missed this slide. I already explained before regarding the customer base. The metadata or the format of the reporting is based on jurisdiction. So the mapping of the customer is based on jurisdiction. And then regarding the submission deadline, since there is a deadline of exchange information, so the FSI should submit to CPINA, the system, 60 days before the deadline for submission for exchange information. While if there is any error, FSI should do a correction. The correction may be initiated based on maybe after TIAS receive the information and do further analysis, there is findings, and then the FSI should do a correction. And the correction itself can also be self-initiative from the FSI. And then regarding the submission of correction, if the correction is requested by the DGT, so it should be conducted in within 1 year ahead. But if is a self-initiative from the bank, is before the 16th day of deadline report. I think that's all that I can explain to you. I would like to also introduce you my college. If you want to ask more detail about this, I have my colleague Muhammad Irawan. Could you please also spotlight him? Yeah, this is Irawan, who is involving in daily technical regarding the this reporting. Thank you. I give it back to you, Christine.
Okay, thank you, Patricia, for the interesting presentation regarding the administration side. Yeah, so Patricia has informed us about the regulatory background of the report submission for exchange of financial account information. Who should report the information, what should be reported, and also the report submission procedure. So we already at the end of this session, and when I check the question and answer part, it's already answered by Dr. Esther, and also Ibu Tias already answered all the question, and also we have reached this to almost 2:30. So I think for the last part, I would like to invite all the speakers to give the closing statement, the short closing statement regarding the topic today is the current development of exchange of information. Maybe from Dr. Esther.
Thank you, Madam Chair, for this opportunity. As we can see, there's a lot of development in exchange of information. All the jurisdictions are working very closely together to improve transparency and exchange of information. So I think as good taxpayers, we are very much encouraged to be compliance, and we hope that voluntary compliance is always top priority, as the tax is a revenue which the government needs for development, and it's for the good of the people. So let's do our part and build the nation together. Thank you very much.
Thank you, Dr. Esther and Ibu Tias.
Thank you, Bu Christine. I also like to invite all the taxpayers in Indonesia to comply with the taxation rule. And because we have exchanging our information with other jurisdictions, it will be easier for us, the DGT, to find the information, even it is kept in other countries. So also DGT using this, the new that will be implemented next year, the voluntary disclosure program also. The AEOI data from other countries will be very important for us also, so that we can check the compliance of the taxpayers. So please report your income and do not hide it. And yeah, That's it. And one more for Dr. Esther. We still have one MOU that is being drafted by us. In this opportunity, I would like to ask you if we can make a progress so that the MOU for AEOI on withholding tax between Indonesia and Malaysia can be signed this year, if it's possible, Esther. Thank you.
Bu Esther still muted. Dr. Esther, you're still
Definitely,
muted.
we have to support transparency, and exchange of information is one way to enhance transparency. So we shall get in touch with you soon,
Yes,
and we will try to sort out whatever outstanding issue regarding the MOU.
Yeah. Thank you.
Okay, now let's move to Ibu Patricia.
Yeah, thank you. We encourage, from OJK, encourage the financial service institution maintain a good database for the reporting. So the information will be useful both for the domestic, for the DGT purposes, and also for the exchange information. Thank you.
Okay, Bu Ratna?
Yeah, thank you, Christine. So the transparency financial data will give a fair tax payment for all the taxpayer. So every taxpayer should pay the same tax. Yeah, how come that the other full pay the tax, and while there are some non-compliant tax still not pay the tax on their asset. Yeah. And then with regard to the SP2DK, the clarification letter issued by the tax office, so that data need the cooperation between the tax office and then the taxpayer. It's just a matter of the clarification that if there is any disclosure required by the taxpayer, then better to give it to the tax office. That's
Okay, thank you so much. Thank you so much for all the closing statements from our speakers. And finally, I would like to thank to all the amazing speakers today, and also to all the participants who already joined today's panel discussion. Hopefully, we can get valuable knowledge and insight regarding the current update of exchange of information. Now, I would like to pass on to Ms. Monica as the MC again. Thank you so much.
Thank you, Ibu Christine Chen. Also, thank you, ladies. What a very insightful discussion. Thank you, Ibu Tias, Dr. Esther, Ibu Patricia, and Ibu Ratna Febrina. As usual, before we end this session, I would like to have a group picture with all of you. I guess you all are on camera, so now smile. We will have a screenshot. I'll count to 3. 1, 2, 3. One more time. 1, 2, and 3. Thank you very much, ladies.
Thank you.
Thank you all.
Thank you all.
Ladies and gentlemen, we are pleased to have Mr. Makbul Lalji, the Director Bureau Van Dijk, a Moody's Analytics company, to share with us about the global data to address tax risks and challenges from digitalization of the economy. Before we commence the session, please allow me to introduce you to Mr. Lalji. Makbul Lalji is a tax professional with over 40 years of experience. Currently, he serves as the Director for Tax Risk Solution of Bureau Van Dijk, a Moody's Analytics company. Prior to joining Bureau Van Dijk in January 2016 as the tax risk specialist, he had the high risk profiling unit in Her Majesty Revenue and Custom Large Business UK. Ladies and gentlemen, without further ado, I'll hand over the session to Mr. Lalji. Mr. Lalji, the screen is yours.
Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Waalaikumsalam. Thank you for inviting me to this International Tax Conference. For the 6th year, I've been attending this. And for the last 5 years, or for 5 years, I've flown over to Jakarta to be there in person. And last year and this year, COVID has stopped us flying. Inshallah, next year, if everything works out fine, we should be able to meet up again in Jakarta and enjoy the beautiful country again. So my task today is to look at the tax risk, how global data can be used to identify tax risks, and especially in this digitalization of the economy. So before that, I will share my screen. I will load my own slides. So if I can just, yeah. So could you all see my slides?
Yes,
okay.
We can.
Okay, thank you. And I just will enlarge it. One second. Display. Okay. Okay. So global data to address tax risks and challenges from digitalization of the economy. And I was so heartened to see that there's considerable, in the last panel discussion, that there's considerable data of exchange information going on, but I also saw the challenges of what data can present, especially when regarding the matching of data. And what's good if data is properly matched up against the system and individuals and corporates are identified, then it becomes that much more powerful to use. So that is something I can address also to some extent, and then we can look at the whole global data to gain visibility of tax risk. So why is global data needed to identify tax risk issues for tax administration? This is very much a tax administration oriented kind of discussion. I always talk from that angle because that is my experience. So what do we mean by global data and digitalization? And how are the tax administrations geared up to the global data? And what are the benefits combining global data and use of advanced analytics? And we'll have some key takeaways after this. So why is global data needed to identify tax risk issues? There's been a considerable hemorrhaging of tax by the tax administrations. Globalization of the last 10 years has seen considerable tax losses. Through your tax avoidance of $200 billion annually, this is the amount which has been shown by the BEPS project. That's through avoidance or profit shifting. About $190 billion of global tax revenues lost through offshore tax evasion. And that is probably quite an underestimation. So there is maybe you can double it or triple it. So that's a big amount. And money laundering is also massive now, 2.8 trillion or 5% of global GDP. This estimated untaxed wealth of individuals in tax havens around 10% of global GDP. Maybe that is an underestimation also. The latest Pandora papers are coming out, more and more information is being shared. So yeah, more and more information is going to be out there for us to use. And there's considerable, the challenges also, there are considerable revenue shortages to COVID pandemic, even because there's so much, the economy has been hit so badly, it's just trying to recover now. So there are massive gaps in the economy and trying to in the way the tax is being collected. So even greater challenges are now, the priority is to identify the right delinquent activities, those avoiders, evasion people, evaders, we need to get them to right. And then there's this two-pillar solution to address by OECD to address the tax challenges arising from digitalization of the economy. So pillar one is to ensure a fairer distribution of profit and taxing rights among countries with respect to largest MNEs, multinational enterprises, which are really the winners of globalization. And but then there are challenges of how do you do this, how do you identify those? But there's a limit of turnover, 20 billion euros and so forth set up. So there's a very large multinationals. To cover that gap, they've introduced Pillar 2, which seeks to put a floor on the tax competition on corporates through introduction of a global minimum tax rate. They're talking about 15% at the moment that countries can use to protect the tax base. Pillar 2 does not eliminate tax competition, but it does set limitations. The agreements will bring much needed tax revenue, apparently. Apparently under Pillar 1, there will be a recovery of over $100 billion a year, expected to be relocated to market jurisdictions. So those all developing countries that have been suffering by being hemorrhaged by the big multinationals are going to see some relocation of profits to the jurisdictions. Pillar 2, the global minimum rate of at least 15% is estimated to generate about $150,000 a year, $150,000 billion a year to the revenue, to the tax revenue globally. So in fact, what OECD are saying that we are losing 240 billion a year through tax avoidance. We are going to put this back through the Pillar 1, Pillar 2 imposition, and we'll get you back 250 billion a year. So that's that hopefully is what is right. There's still considerable time, way to go forward. I think they're going to have a signing of the agreements, I think this month. They'll try to then set up the legislative framework next year, and they'll try to implement it in 2023. But there are of the inclusive framework of 139 countries or so. There are some who are not agreeing to this, but there are some 130 countries who have agreed to this, which accounts for 90% of the global GDP. So there is considerable progress, but let's see. But there are also gaps in the Pillar 1, Pillar 2 side of things. Let's have a look and discuss this later on. What do we mean by global data and digitalization? The global data, what I mean is equates to big data for tax administration, from a tax administrator point of view, giving them global visibility across border transactions. And this is more important now when you have such big exchange of information going on between tax administrations. So we need more and more global visibility across border transactions and so forth. But also we need to make sure that all the data that we are collecting, we are making use of it. So big data describes the large volume of data, both structured and unstructured, to give global visibility. It inundates businesses, tax authorities, tax administrations on day-to-day basis. But it's not the amount of the data that is important. It's what the organizations do with the data that matters. So big data, global data can be analyzed for insights that lead to better decisions, strategic business moves. And for tax administrations, enable them to match their data to individuals, corporates, or those deviant behaviors, to stop those deviant behaviors, stop tax avoidance, stop tax evasion. It's easy to say, but it's very difficult in practice because, first of all, as the earlier panel informed us, the data matching is not an easy task at all. And from my own experience, data matching is one of the hardest things you have to do. That's the work you have to undertake. Once you start data matching properly, then you can link up all the data and get the global visibility. So digitalization in its basic form from a tax administration perspective means embracing new technology to undertake and analyze electronically captured transactions. So a lot of the tax administrations nowadays are working in this world, in this area of digitalized data, electronic data, and capturing data. From an economic perspective, we now are talking about how the multinational enterprises across the globe, where they have a physical or non-physical virtual presence in jurisdictions, OECD's two-pillar solution. So we got the two kind of digitalization. Digitalization of the data itself in electronic format, how that can be used by tax administrations. And on the other hand, how could you tax those economies, the market economies, where those multinationals how could those market economies benefit from those multinationals operating there, and could they be taxed? And that's the solutions are coming under Pillar 1, Pillar 2 of OECD's program. This is a complete new change in the international taxation area. So it will take a while to settle in, to look at it. And I'm sure there'll be a lot of gaps in this which could be exploited. So what do we mean by this global big data tax administration? So as from the earlier panel, we saw this lot of tax treaty data, BAPS, country by country data, report sharing, exchange of information across jurisdictions, competent authority exchanges, and so forth. There's also considerable amount of external data out there from CRS, a common reporting standard, wider government bodies data information from conventions of international trade, CITES, and so public information disclosures. And you're talking about the Panama Papers, Pandora Papers, and so forth. And so we got a heck of a lot of data out there. And from a tax administration point of view, they collect a lot of data themselves directly, electronically lodged forms, claims, returns for individuals, partnerships, corporation tax, VAT, and so forth. Data also corporate accounts in XBRL formats, tax computation, very important part of this internal data to have. And that needs to be also very quickly matched to everything else we have in a tax administration. Also, there are these Internet of Things. We got web robotics script information going on. A lot of these systems are scraping information, social media information, archive data. I was yesterday talking with some IT company which work in collaboration with us, how they use that kind of data to match. So it's very interesting how they develop neural networks and so forth. So from a commercial point of view, Moody's Analytics, Orbis, they have considerable amount of data themselves. Historical financials going back to 2010. Financial strength indicators, your risk indicators on companies folding and so forth. So we got a lot of indicators, a lot of models in our database. The commodity pricing data, we got lending margin data, original scanned documents with financial notes going back years and years. We got tremendous amount of shareholder data, subsidiaries data, beneficial owners, 150 million beneficial owners globally, historical ownerships, links about 1 billion, and the ownership links to or around 1.2 billion globally, company information around 400 million, financials over 36 million globally. That is detailed financials, mergers and acquisition data across the globe, up to the day data, cross-border investment data, intellectual property data that's from LexisNexis of about 120 million patents information matched to the Orbis database, regulatory information on PAPs and sanctions and adverse media, news and industry reports. So there's lots of data, structured data, unstructured data, but the key element is tax administration has access to those kind of data. How could they use it in a more constructive possibilities for looking at tax risk, tax evasion, tax identify frauds and avoidance? All this data cannot sit in isolation. They need to talk to each other. They need to talk to each other. How do you make them talk to each other? You need to match it. And the matching is taking a clean spine of data from, say, something like Moody's Analytics on corporates with their clear identifications, structured identifications, and then linking all the data that they have, the company information data, the individuals data, 375 million individuals in that database, the beneficial owners data, 150 million, and then you got your historical links, all the shareholder links, everything linked up together with that data, and then matching it, clean spine of data, matching it with the tax authority data and the third-party information. So this kind of work is not easy, but it is done, it is possible. And how are the tax administrations are geared up to this, using this kind of global data? My own experience has told me over the last 10 years, there has been concerted effort to develop advanced data analytics. Since 2015, there has been growing trend to large investments in digitalization. That is from an tax administration point of view, revamping the systems from the old relational databases to the new electronic Hadoop kind of databases, large databases. Data architectures have been creating data hubs, using new toolkits, including artificial intelligence, recruiting new brand of data analysts, data scientists. These guys are very clever nowadays, data scientists with double PhDs, so they're the cutting edge stuff. And so like HMRC, they have recruited over 600 of these in the last few years. And Australia and places like that are recruiting a lot of those data scientists. A lot of other countries are doing the same. So blending this global third-party data with administration's internal data, I think is a key thing. And there's a growing appetite to procure commercial data for effective tax risk assessment. And this is, we have been seeing a lot with the tax administrations of late. So let me take you through a journey. Way back in 2010, this is from my own, I was at a conference in London when we met some large business representatives from the tax authorities. And around 2010, the tax authorities with the capabilities of the advanced data analytics, that's what I mean, had a data mining mart, and they had some data scientists working, looking at bigger data. There were only about 8 under 10. There were Australia, Canada, France, Japan, Netherlands, Singapore, United Kingdom, United States. The global map has changed over the last 12 years. So now in 2020, more than 42 administrations were there. So you can now see across from Argentina to the United States, you can see East Africa, South Africa, Eastern Europe, Asia, and getting very digitalized, very advanced. So you get South America, Africa, and so forth. So this is spreading, but still it's not out there. It's only 42, according to my review, the 42 advanced data analytics is being used by tax administrations globally. So there's quite a way forward to go yet to improve the architecture, the capabilities of advanced data analytics to make use of all that extra data that we are collecting. And the best way to do it is, really speaking, creating the big enterprise data architecture, putting all the tax administration data from this side into a Hadoop data lake, putting all the commercial data into the lake to match it with a strong spine, the external information that's been collected, BAPS, Pandora papers, and everything else, exchange of information, all this information through there. Then allowing proper data matching to happen here and creating upstream traditional business intelligence, using traditional business intelligence to do the simple upstream risk management as the data comes in from the gateway, electronic data, and using junior executives or the tax analysts to this kind of upstream tax risk management work. And downstream, enabled by APIs, advanced analytics, neural networks, text and data mining, you can use all this output, then you can use your highly professional trained individuals, data scientists, tax inspectors, tax investigators, and policy people, professional, and using the professional data to do their own policy work, identify the risks and so forth. So this is not an easy task, but it is what is possible. It's being done, and more investments needed, especially nowadays with all this data being exchanged and to make good use. And especially now under BEPS 1 and 2, how do you monitor all this? You need some kind of data, handling of the data. Are the large corporates themselves gonna disclose everything? You need to monitor. Yes, yeah, I'm sure they are going to do that, but you need to monitor, and also you need to monitor those are going to miss what BEPS 1 and 2, sorry, what Pillar 1 and 2 might catch. So from a data modeling point of view, this is an example of a large multinational structure. And this is over 500 odd subsidiaries globally across market jurisdictions and so forth. So this is, we can see it. I look at it every day virtually in my work, and I see a lot of multinationals with a lot of complex data, complex ownership structures. So what do you need? You need to look at it in a more analytical way, and you need tools and data to be scrutinized. And this is something where you can do. I have written a lot of algorithms to clear, to show those kind of structures. And this is a typical large US multinational using the Dutch PV holding structures, Swiss intellectual property, holding companies, and then making use of treaties, application withholding tax to avoid withholding taxes or minimize withholding taxes on interest payments, royalty fees, dividends, and the various other kind of profit income, profit shifting that goes on. So this is, for example, this is a Southeast Asian manufacturing company, then a large company of around 2 billion turnover, and then you got your another holding company in a low tax jurisdiction in Southeast Asia, and then you got the Netherlands company. So you got those kind of structure and various ways of profit shifting. Hopefully, Pillar 1 will stop this. If not, Pillar 2. Let's see. But would it do it or would it not? Yeah, the proof of the pudding is what we'll see in 2023. And another example of depicting shareholders, parents, and companies. This company is owned 100% by Indonesian beneficial owners. So the control is there about total up to 100% of the group parent company based in Singapore. So they're using the low taxing and favorable jurisdiction for that. You got your territorial system, you got the global system. So they're using in between, and there's where you could exchange of information. There's double taxation treaties. There's all those information advantages, or you can minimize your double taxation and so forth. And then you got your base of large businesses, again, based in higher tax jurisdictions. So this possibly might be caught under BEPS 2 because the turnover minimum is 750 million euros. So that might be caught. But what happens when those individual beneficial owners may have businesses under the 750 million turnover threshold? So there are many out there. So are they going to escape BEPS 2, Pillar 2? So those are the questions. This is not cut and dry, but there are complexities. There are ways of doing things. And this is where the tax authorities need to monitor exchange of information, linking up the data. When they call for voluntary disclosures, yes, some will come up, some will won't. But you also need to be able to create your list of possible high network individuals, which will have those kind of businesses, which will have exposure to low tax jurisdictions, your Cayman Islands and Virgin Islands and so forth. And how do you monitor that? You need data to do that. And this is something else which you need to be able to do with the data. And then what about BEPS? The Pillar 1, Pillar 2? Does it catch your complex secretive structures? Does it catch money laundering? This is a sanctioned individual who large fund has been introduced. And then they are using the layering system, layer one, putting the funding through the investment holdings in Virgin Islands, trust in Guernsey, in GB, in Britain. And then there are nominee companies in Hong Kong, single purpose vehicles coming in for one big transaction and going into dormancy. From dormancy becomes live. Then the transactions go back into dormancy. Nominee accounts, nominee companies in account or headed by a director, nominee directors and so forth. Management companies, legal companies, financial companies, hedge funds, asset holding companies and so forth. So money is siphoned from different layers, and then it's become legitimized through normal trading in Southeast Asia, in Japan, again, and Southeast Middle East, Africa, Canada, US, you name it. This is how it is done. How is this tax evasion is going to be caught? Data is the answer. Big data, analyzing big data. Pillar 1, pillar 2 might go somewhere, but that's avoidance kind of side. This is more evasion. And exchange of information is very essential in this world. Looking at those kind of banking information, Pandora paper, and then you got those disclosures, Pandora papers, and Panama papers, you name it. So you need to utilize all that information together. So what are the key takeaways? I think, yeah, just exact timing. So global data can be employed with advanced analytics. Gives you complete visibility of tax issues across tax jurisdictions. And the two-pillar solution doesn't address everything, I think. And it will be a while before it does that. There are a lot of politics involved in this area. Global data is a key component of the two-pillar solution. How do you implement the models? How do you monitor this? You need data to do this. Marketing jurisdictions, are they just going to take it on the word of what the multinationals say that this is the distribution? They need to check. You need to challenge. There will be disputes. You need data to support all that. Then global data is essential for tax industry to reduce the increasing tax gap. COVID has created quite a lot of tax gap there. Hopefully the recovery of the economy might get it back. Pillar 1, pillar 2, suggesting that will bring back $250 billion per year. That would be great, but there will be still a big tax gap, especially around the evasion area and the illicit money laundering area. So data is needed to scrutinize this information and to use it in a more actual practical way to find the deviant taxpayers or deviant non-taxpayers, to say. I think I'll leave it at that. Hopefully that gives me my half an hour. Thank you.
The insightful presentation.
So we can, if there are any questions, we can send it over to us and then we can answer it and so forth. So that would be easy to do.
Okay.
I don't see any questions here.
Makbul, there is one from Wempi Maron. Yeah, perhaps you can advise on that.
Okay, is the acquisition of Orbis data legal? Yes, we don't get anything in our platform which is not legal, and the data is correct as this in words of data. This is as correct as good a data you can get anywhere in the world, and we buy it and we do a lot of checks on that. So, but with data is as good as you can get from outside, and that's the best quality data, we get it. And our analysts, we run algorithms, we check our data quality, we work at the ISO standards. So as far as for 95% probability, our data is correct, more than 95% probability. And we only get legal data. We can obtain legally. Any more questions? If not, then if you got any questions, if you can pass it through to us, Margareta will take it and then we'll deal with it, hopefully.
Okay, thank you very much, Mr. Makbul Alji, for a very insightful presentation. And we will surely inform you if there is any question from participant for you.
Or tax authorities or anyone we can answer those questions.
Ladies and gentlemen, that's all from Mr. Makbul Alji. I guess we're going to continue our next session. We will discuss more about international aspect of law drafted of general provision and procedure. As the panel, we will have Ibu Dwi Astuti, the Deputy Director of Dissemination Service and Public Relations DGT. We will also have Mr. Graham Garvin, the partner VDB LOI, Ibu Cindy Sukiman, Deloitte Indonesia, Merger and Acquisition Tax Leader and Energy and Resources Leader, Deloitte Indonesia. The last, we will have Mr. Sivakumar Saravan, the Senior Partner Tax and Corporate Services, Crowe, Singapore. This session will be hosted by Ibu Zahra, KAPJ IAI member. Before I hand over the session to Ibu Zahra, please allow me to read a brief CV of Ibu Zahra. Ibu Zahra is the Audit and Risk Management Manager at Premier Oil, a harbor energy company. Her expertise, among others, are international tax, corporate tax, cross-border transaction, merger, restructuring, and dispute resolution process. Ladies and gentlemen, I would like once again remind you to use Q&A function to submit your question. You should also state to whom your question is being asked. Okay, ladies and gentlemen, now I will hand over the session to Ibu Zahra. Ibu Zahra, the screen is yours.
Thank you, Ibu Monica. Assalamualaikum warahmatullahi wabarakatuh, and good afternoon, everyone. Welcome to panel 4 sessions of today's International Tax Conference with subject of the new era of global tax transparency. I'm Zahra, and I'm delighted to be your moderator for this 75-minute sessions. As we are aware that the House of Representatives passed a bill last week, was taken on Tuesday, to fix the country's tax system. Previously, it calls the amended General Taxation Law, or KUP. Now, with its new name, the Harmonized Tax Law, this draft of law have put significant changes. Among others, it raised personal income tax, except for the richest, that have annual taxable income of 5 billion rupiah, or equivalent to $350 US. Increased value-added tax rate, reductions of corporate income tax, and then introduce carbon tax and voluntary disclosures. The governments, the Indonesian government, expect that this reform will strengthen the economic foundation by increasing annual tax collections to reconsolidate Indonesia's current fiscal positions. These sessions will discuss the aspect of the recent draft of tax law and its impact to the international taxations. For that, it is an honor for us that we have such a perfect blend of our experts for these sessions. Ibu Dwi will speak from DGT perspective of international aspect of the bill. Pak Grahams from foreign investment perspective, Pak Siva will share Singapore MAP process and brief comparisons to Indonesian MAP, and Pak Cindy for tax collection assistance under the new law. Just a little housekeeping, like Ibu Monica said before we get started. So if you have any questions, please just type it into the question box in your Zoom panel, and we'll bring up to the presentations, to the speaker, to the presenters. And okay, let's start with the first speaker, Ibu Dwi. Let me introduce Ibu Dwi to her CV, please. Ibu Monica. Yeah, Ibu Dwi current position is a Deputy Director I think this is the previous position, isn't it, Ibu Dwi? Sorry about that. I think we have the latest CV, Ibu Monica or Ibu Faiza. So yeah, sorry for this. I think Ibu is currently the Director of Exchange of Information. The Deputy Director of Dissemination. I'm sorry, Ibu Dwi. Dissemination Service and Public Relations of DGT Indonesia. And previously, he held a position as a Deputy Director of International Taxation for Dispute Prevention and Settlement in the DGT. And without further ado, I would like to give Ibu Dwi the time to speak. Over to you, Ibu Dwi.
Thank you, Ibu Zahra. Good afternoon, ladies and gentlemen. It is actually a great opportunity for me to share with you. Actually, this is the first event held by the Digitex. I mean, from our side to openly public the content of the harmonization of tax regulations bill. We still call bill because it's not yet signed by the president. Maybe it's not so long anymore. It will be signed, and then by the time it is signed, we'll call the harmonization of tax law. So please share my slide presentation. So I think it will be beneficial if before I explain further regarding the international taxation aspect in this regulation, I would like to maybe slightly inform you regarding the background and the urgency of the structural and fiscal reform in Indonesia. So it will give you the complete idea, the complete brief. In a complete brief to you what was happening regarding this fiscal reform in Indonesia. So, and then before that, I would like also to convey to you that I just want to explain the international taxation aspect of this bill. It's not all the complete since the time's only like 15 minutes. Bu Zahra, if I exceed the time, just please remind me. So that's why to save the time, I just again to tell you regarding the international taxation aspect only. So actually, as the background, it is realized that Indonesia has a big dream to face the onward Indonesia 2045. In that case, we have a dream to also become one of the big economy in the world that have advanced in terms of the economy, in terms of the service. Next slide, please. That is also become our motivation to always reform or to always giving the new policy in terms of the taxation. So before that, we also have considered that our demography bonus in this case, that we have 309 million of population. In half of that is like in the productive ages. So in this case, we do have like a bonus to from our population to move forward regarding our economic development. But before that, we have to consider also the precondition we have to address before we going onward for 2045. Of course, we should have adequate infrastructure. We should have excellent human resources. It's not enough that we have like productive ages without having sufficient knowledge and competence. So that's why we still need to increase our capacity and our capability in terms of the human resources. And then again, in terms of the technologies, we have to like adopt the recent technology in order to make or to grow our economic. I think it is a common knowledge everywhere. And then we have to also good regional development, as you also aware that geographically Indonesia is very long, wide from east to west, that many islands there. So some of the islands, some of the regional of or the province in terms of the development is not yet like have similar or balanced development with other with Jakarta especially. So that's why if the president move our capital city to another island, somehow it will be pushed the development in other regional of Indonesia, in other region of Indonesia. And then last but not least, we have also the precondition as we have to have good economic policies. So in response to that, especially for the economic policies and then also in terms of the adequate infrastructures, we now have the tax reform in Indonesia. We just completed now in form of the taxation law. So it is a very what I can say, realize that without the tax reform in Indonesia, we could not pursue what we so-called precondition for Onward Indonesia 2045, because we do have to achieve a fair, healthy, effective, and accountable tax regime in order to support the development or to accelerate the Onward Indonesia 2040. In this tax reform, in the next please, in the policy reform, we try to expand our tax basis in order also to address the competitiveness of its challenge. I think it is in this development with this digital disruption or technology disruption, it is encouraged many countries to also what you so-called raise the competitiveness amongst countries. Also, as the response for this COVID-19 that bring the future into now, many countries has compete each other to heal from this pandemic situation. So in this case, Indonesia has also to adopt with the dynamic of the global taxation. This is the most relevant, I think, most relevant what you call the basic, amongst other, to push Digitax to accelerate the tax reform. And then also in the administrative reform, it is also very important that we have to adopt the development of the global economic structures, including the digitalization of the economy. As I mentioned earlier, it is also need the high cooperative of the compliance, and it is also need the optimal use of the financial data and information, and many other things. So this is also one of the reasons why we need to always conduct the tax reform. Next, please. So that's why we conduct the amendment of our income tax law, the general and procedural, and then also the VAT law, in order to fulfill our dream or to become to fulfill the precondition of our dream to Onward 2045. So as I mentioned earlier, next please, I just want to tell you briefly regarding the international aspect of the harmonization of the tax regulation bill. So basically, in this bill, the principle is that the fairness, the simplicity, the efficiency, the legal certainty, the expediency, and also the national interest. As I mentioned earlier, this bill, it is, I mean, the process is very short. It is only 3 months since we bring the amendment draft to the parliament using the president's letters. It's just like 3 months ago, and then with the goodwill of the government and also the parliament, we could conclude the discussion or the plenary just within 3 months. It is like actually a landmark also. It is, I think, this is the first time that we conclude the bills only 3 months. With the same we have the same objective actually between the government and the parliament, that is we want to increase the growth and support the accelerated economic recovery because of this pandemic situation. And then also we want to optimizing state revenues. Of course, we need more money in form of or regarding to heal the economic situation of Indonesia because of the pandemic situation. It is not only of Indonesia, but since that our state budget, it's mostly come from the tax. It is almost 75%. The state budget is came from the tax, so that's why we need to optimizing our state revenues. And then we want to also realizing a tax system that is fair and with legal certainty. And then also we want to implement the administrative reform, consolidated taxation policies and broaden of the taxpayers. And then the last but not least, we want to also improve the cooperative compliance of the taxpayer. So in terms of the enforcement, we would like to, and we would like you to pay the attention or to fully aware regarding the effective date of the enforcement, because it is the content is like because of the variety of the content, as I mentioned earlier. So the enforcement also has a different date. So please be aware regarding this.
3 minutes.
As for the amendment of the income tax law, it will be effective from the taxable year of 2022. For the VAT, it is from 1 April of the 22. As for the general provision and tax procedure law, will be start from date of the promulgation. We do have introduced the voluntary disclosure program. It will be available from 1st January to 30th June of 2020. For the carbon tax, it's from 1 April of 2022. And then for the custom law, it will be effective from the date of promulgation. So this is, again, once again, you have to put the attention regarding the enforcement date, because it is, like I said, this is vary from one to another. Next, please. I just want to describe, this is the situation when it is being agreed in the House of Representatives, being approved also. So next, please. So I would like to now giving you the complete what is already being agreed in the bill. Next, please. I know maybe my time is like it's not long anymore, but I try to accelerate. So in terms of the international cooperation for tax collections assistance, it is now, we do have the legal basis for that, as at least 13 jurisdiction or 13 DTAs already signed that have the clause for the assistance of the tax collection. So now we don't have any doubt if we want to help other jurisdiction to collect their tax in Indonesia, and reciprocally, we have no doubt also in those 13 jurisdiction if we want to ask them to assist us in collecting the tax. And then also we have now the legal basis for mutual agreement procedures. Now it is stated in the bill, because previously it is only in the government regulation. Now we have a strong legal basis for mutual agreement procedures. Next, please. Next is regarding the anti-tax avoidance instrument. Next, please. It was proposed that we want to have general anti-avoidance rules, but unfortunately, it is not approved by the parliament. So instead, we expand our capacity or our authority in terms of anti-avoidance instrument. Oh, sorry, that's B. And then also we do have a bilateral or multilateral agreement. This is for multilateral, bilateral or multilateral agreement, it is giving the legal basis in order to capture or to implement a global consensus of taxation and digital economy also. So it is become a strong foundation or strong basis if later on there is a consensus of global, a global taxation of digital economy or global consensus on taxation of digital economy. So now we do have the legal basis in our domestic regulation. Next, please. Next is regarding anti-avoidance instrument. As I mentioned earlier, that our GAR unfortunately is not being approved by the parliament, but instead we expand the authority in terms of the specific anti-avoidance rules. So now we have the authority if maybe during the implementation of SHAR we find out there is another scheme, there's another re-engineering regarding the tax avoidance instrument in terms of the SAR. So in that case, we could like make the regulation, implementing regulation in responding to that development. So in one side we lose guard, but the other on the other side we strengthen our specific anti-avoidance rules. Next, please. So
we don't have more time.
This is okay.
Yeah, probably you just want to go through quick, Ibu.
Yes, will do. But it is very important. I think this is the voluntary disclosure program. This is VDV. People always say this is the tax amnesty, second part of the tax amnesty. This is not the second part of the amnesty. This is just like the other kind of the instrument, the other kind of instrument to push the voluntary compliance to the taxpayer, so that we called voluntary disclosure program, and I think it is a common program also according to an international best practice. Next, please. I don't want to spend much time regarding how the policy apply. I think you can read it. But I just want to say that in terms of the tariff, it's much more higher than the tax amnesty. That's why we don't call it the tax amnesty. So please, I think the last part of my presentation. Next, please. It is regarding the income tax rate in Indonesia. It is nice to know also for you. The next, please. Regarding the bracket, we expand the bracket from until 60 million for the lowest tariff. And then the highest tariff, 35 million, we should also expand the bracket. The tariff from the income start from 5 billion upward, it will be now at 35%. And I think it is also still in terms of next, please. In terms of the international best practice, if we compare to the average CIT rates in the world, it is still modest, I think. In terms of the CIT rate, because we know our CIT rate in the bill is like 22%, and we as I mentioned earlier, sorry, I'm just rushing myself, so I a little bit not clear. So again, for the CIT, we still hold the 22% rate because it comparable the CIT rates in the world. So this rate is still modest. I think it's still acceptable. Next, please. Yeah, that is my last presentation. Thank you very much for your kind attention. I'm so sorry because in the last part of my presentation, I'm not so clear because my time is already finish. Thank you, Zahra.
Yeah, thank you, Bu Dwi, for elaborating the policy reform under this bill, not law, right, Ibu? And in particular related to the international tax aspects, like I heard about bilateral, multilateral agreements, and also digitalization of economy and anti-avoidance instruments. And not the tax amnesty, the second part of the tax amnesty, but its voluntary disclosure program.
Yes.
And now all of those programs have become the government effort actually to adapt to the dynamic of global taxation system.
Yes.
Thank you, Ibu Dwi.
Thank you.
Now from the government perspective, let's listen to Pak Grahams, who will share the insight of the provisions of the new harmonized tax bill from the foreign investor point of view. Let me read Pak Graham's CV. So there's quite a technical issues. Do we have Pak Graham's CV, Ibu Faiza? Okay, Pak Graham, he has 30 years of experience of professional tax, and 20 of which have been in Indonesia. He is widely acknowledged as one of the Indonesian most experienced foreign tax advisor. He was formerly a partner with KPMG Indonesia, where he established its transfer pricing practice. And his area of focus is aside from transfer pricing, dispute resolution, transactions, M&A, and he has advised on local and international private equity transaction and assisted new entrants to the Indonesian market. So let me turn the time over to you, Pak Grahams.
Thank you very much. And thank you, Ibu Dwi, for the very insightful summary of the regulations. I think if we can start the presentation. Thank you. Okay, so very pleased and honored to be a part of this panel. So I'll just, I know that we're probably a little bit behind schedule, so we'll motor on. Next slide, please. So as Ibu Dwi went through, basically the new harmonized law covers some procedural changes, some income tax changes, some VAT. Apologies for calling it the Amnesty Mark II, but I think that's the colloquial term for it, regardless of the official term. Introduction of carbon tax and some small changes to the excise duties. Next slide, please. But you know, as we've kind of heard from other panelists and from Ibu Dwi herself, you know, this is basically part of global changes that are happening, and the G20 and others are really moving tax up the agenda. A lot of the changes are not purely Indonesian changes. But what we want to focus on here is really, you know, what are the changes within Indonesia which will have an impact on foreign investment, whether that's potential foreign investment or those foreign investors who are already here. Next slide, please. So there's truly international aspects, and we'll hear later from the other panelists about collection and MAP. There's also other agreements and some small mention of the digital economy. Next slide, please. So as I say, there's collection, MAP, other agreements, and digital economy. These are the truly international aspects. Next slide. In the collection side, as I say, you will hear more in more detail later, but basically there's the ability for cross-border collection of taxes, and this is all very new to most countries, so I think we'll need to monitor and see what the impact and the issues will be from that. Next slide. Next again. So MAP, you know, a lot of the changes are basically just moving up the already in place provisions into law. But again, you will hear further detail later. So next slide. Other agreements is something that was is mentioned in the harmonized tax law. Actually, there's many other agreements have already been entered into in advance of the harmonized tax law. So next slide, please. So this is a QR code that gives access to the synthesized text and the matching between jurisdictions for the synthesized text that comes from the multilateral instrument. So basically, many of the double tax agreements have already changed, but there are some aspects of the synthesized text which have not been adopted in the Indonesian double tax agreements. So there could have been clarifications that have not been adopted. So we need to kind of adapt to that. Multinationals need to adapt to what are the double tax agreements that they deal with for Indonesian investments and what they deal with on other cross-border aspects. Excuse me. Next slide, please. And then the digital economy, which just next slide, please. I'll go into a little bit of explanation of that. So basically, the digital economy aspect that I was able to identify from the changes are basically that those entities which have been appointed as VAT collectors, for example, like the Googles, etc., are subject to the same sanctions, etc., as local VAT registered players. So just whether this is part of leveling the playing field and what the actual issues were and what the complaints were maybe is something to consider. Next slide, please. So yeah, the rest of my presentation basically wanted to look at what's the overall impact on foreign investment. Next slide. So impacts on foreign investment, there's three main aspects that I see. Is that are we looking to attract the right investors? Are we able to maintain those investors that are already here, the ones that Indonesia wants to maintain? And by the way, very ambitious target for 2045, and the best of luck. I think everyone is trying to assist with meeting those targets. But it's useful we need to listen to business and to investors to help with that whole process. And leveling the playing field, I think I'll go into that in a little bit of detail later. Next slide, please. So attracting the right investors. Again, next slide. So as we've heard, and as I think everyone knows, the corporate income tax rate has been cemented, I suppose, at 22%. This is one aspect that's really caused quite a lot of concern, I think, because there was also already in place that 20% should apply from next year. A lot of calculations, a lot of investments. Sorry, not move on yet. Back, please. No, a lot of investments planned on the basis of 20% corporate income tax. A lot of advice gone out. Certainly, I've given a lot of advice that 20% will apply next year. And now, last minute changes. We now have to reconfigure everything at 22. And then an increase in the VAT. Whether that has an impact on investment is debatable, but certainly has an impact on the calculation issues, because it's a little bit more difficult to calculate 11% than it is for 10%. But let's hope that has the desired effect. But sorry, next slide. In terms of attracting the right investors, the direct competition is principally within ASEAN. And the delay in the 20% rate means that we're behind Vietnam as if we're only looking at the tax rate, the top tax rate. Then we're a little bit behind, and we need to compensate in other ways, I think, to make sure that when there's competition for investment, that Indonesia wins. Next slide, please. And maintaining the right investors, I think there have been some investors have left, principally because of tax issues. And I think it's important that the good momentum that's been built up with the dialogue with the more user-friendly approach of the tax office. We need to make sure, I think, that continues to avoid any other bleeding of investment. Next slide, please. So keeping up the momentum, the business-friendly approach. I think it's now very, very easy to talk to the tax office, or sorry, a lot easier to talk to the tax office. I think there's still some problems, but I think they're largely being overcome. And some people will actually just advise people just to go to the tax office for advice rather than go to a tax advisor. In many cases, that might be the right approach, but in others, it might not be the correct answer for that specific context. But the business-friendly approach, the dialogue, I think we should encourage that to continue and increase. Next slide. Next slide, please. So I think the overall message, I think, from foreign investment is that from a regulatory point of view, one of the biggest things they're looking for is certainty. And so, things like the last minute changes don't help, certainly in the short term, but, hopefully that will be overcome very quickly as, the government or the government is looking at the bigger, Parliament at least is looking at the bigger picture, and hopefully they've got the right answers. Next slide. And the other thing is leveling the playing field, and the questions really would be, excuse me, next slide, is whether is there good signs for the foreign investment community that the widening of the tax base, the strengthening of the enforcement issues, etc. Sorry, next slide. Should that prevent or reduce some of what's been thought of as hunting in the zoo? Those taxpayers who have been compliant historically, a lot of auditing of those that are compliant and actually overpaid taxes. There's a lot of abuse, that's sure, but there's also a lot of people a lot of taxpayers who have been unfairly discriminated against, and I guess the hope is that that will reduce as compliance and the tax base widens. And I think just keeping up the dialogue and the discussions with the business community it will help a lot in maintaining the trust of the foreign investment and domestic investment, to ensure that there is that certainty, and investment decisions can be made without fear that there will be a negative tax impact. I say next slide, but I think my thank you slide might not be there. So that's the end of my presentation. Thank you very much, and we'll wait for any questions. Thank you.
Thank Graham. You are on time. And thank you again for providing a brief summary on how to attract the new investors, maintain existing investors, and how competitiveness plays significant roles among other countries. And it is also interesting on the concerns that was addressed on the CIT rate, that the government had decided not to impose a corporate tax cut for the next year, remaining like 22%, which differ from the omnibus law provisions of 20% and the slide associated with certainty, which is, we know that it's the most important requirement for foreign investors. Thank you again, Pak Graham, for your thought-provoking insight, actually. And now it's time to listen from other country perspective, that we try to have the elaborations of the changes, in this case of the MAP programs. And we take examples of Singapore MAP procedures. Pak Siva will speak on this. Can we Siva see please? Pak Siva is a senior partner and head of tax at Holy Singapore, and he has about 25 years experience in tax compliance and tax consultancy work for individuals, corporations, listed companies, multinational and financial institutions. And he also has extensive experience in advising clients of international corporate and personal, and also for various cross-border transactions for Asia Pacific regions. And Pak Siva holds a bachelor degree from Nanyang Technological University. And Pak Siva, over to you, Pak.
Thank you, Ibu Zara. Thank you, Ibu Sarah. Good afternoon, everyone. It is my pleasure and privilege to be part of this panel discussion today. This is actually my second year in participating in this International Tax Conference. Can we have my slides, please? Okay, thank you. Just now, Ibu Dwi touched upon several developments, one of which is the changes to the MAP guidance and regulations in Indonesia. It is indeed heartening to know that Indonesia is putting some emphasis on MAP as an alternative dispute resolution mechanism. This is welcome as taxpayers seek more certainty when it comes to cross-border tax disputes. Pak Graham also mentioned about the importance of tax certainty. So I'd like to follow from there and provide a quick background to the MAP process in Singapore and round off the discussion with a comparison between Indonesia and Singapore. Next slide, please. Now, as a background, the MLI allows countries to quickly amend their tax treaties to implement the tax treaty related BEPS recommendations. The MLI also improves on the dispute resolution mechanism. Now, all of Singapore's tax treaties include a provision relating to MAP, which follows Article 25 of the OECD Model Tax Convention. Now, to be fully compliant with the four key areas of dispute resolution mechanism under the Action 14 minimum standards and other BEPS minimum standards, Singapore signed and ratified the multilateral instrument on 21st December 2018, which came into force on 1st April 2019. Now, as of October this year, about 47 tax treaties have been amended through the MLI. Next slide, please. So just a quick recap. While MAP, which falls under BEPS Action 14, is a minimum standard, with respect to the other recommendations, such as mandatory binding arbitration, a country is given the flexibility to opt out entirely, or in some cases, opt out of a provision through the mechanism of reservation. Next slide. Now, this shows Singapore's MLI position with respect to BEPS Section 14. So besides BEPS Section 14 minimum standard, Singapore has also opted for Part 6 of the MLI concerning the introduction of a mandatory and binding arbitration provision in the tax treaty. Now, prior to the MLI changes, the arbitration provisions were present in the Singapore-Mexico tax treaty. Now, with the MLI changes, the arbitration provisions are included in more treaties. Next slide. Okay, now a brief look at the Singapore's MAP program. Next slide, please. Now, Singapore has an established MAP program. The Singapore Tax Authority has also published tax guidance on the availability as well as the applicability of MAP in TP cases as well as non-TP cases. Currently, Singapore has a relatively, I would say, a modest MAP inventory with about 24 new cases received last year and about 11 cases completed in 2020. I think this is lower than the MAP cases received in Indonesia. But from the table, we can see the uptrend. So in 2016, just 2 cases, and there's been a significant increase since then, also coinciding with the release of the BEPS final report. While the table shows the MAP cases from 2016 onwards, please do note that there were MAP cases received and completed prior to 2016. But for illustration statistics, I've just shown from 2016 onwards. Now, with respect to the second stage MAP peer review, which was completed last year, and the report was issued on 12th May 2020. The report indicates that Singapore has met almost all of the Action 14 minimum standards. Next slide. So now let's look at some key features of Singapore's MAP program. Firstly, legally, taxpayers can seek resolution through MAP and through available domestic remedies. So effectively, they can pursue both. Secondly, taxpayers would be able to access MAP even if they have accepted or decided to accept a tax settlement with the Inland Revenue in Singapore. However, taxpayers must recognize that it could be challenging for the foreign competent authority to negotiate and come to an agreement on a position that deviates from the tax settlement outcome reached in Singapore that was already accepted by the taxpayer. Thirdly, taxpayers can request for MAP even if the taxpayer has sought to resolve the dispute through the courts. However, where the matter has been subjected to litigation and determination by the Singapore Court or Tribunal, the tax authority is unlikely to amend the transfer pricing adjustment or any other tax adjustments that depart from the determination by the Singapore courts. So this also kind of similarly applies to a taxpayer who sought resolution in a foreign court, right? So in that case, the taxpayer should inform the tax authority if the matter is adjudicated through any legal or judicial proceeding in a foreign jurisdiction while the MAP process is still ongoing. So this will allow the competent authorities to discuss and decide if the MAP process should be continued, ceased, or suspended. Next slide, please. Now, where the taxpayer initiates tax adjustment voluntarily in a foreign jurisdiction, such cases are also covered within the scope of MAP, as long as the adjustments are supported by proper transfer pricing documentation. Now, Singapore has GAR as well as specific anti-avoidance measures under domestic law. So issues arising from domestic anti-abuse provisions can also be covered under the scope of MAP. And this will basically depend on the merits of each case. Finally, there's basically no time limit in implementing the outcome of MAP, as the domestic statute of limitation will be lifted for upward adjustment. So there was actually an amendment to the law that allows for that. And currently, there's also no domestic time limit for downward adjustment. Now, this is actually despite the fact that in some treaties that are not amended by the MLI, the treaty may not contain a provision stating that mutual agreement shall be implemented, not withstanding any time limit in domestic law. So even if those provisions are, not contained in the treaty, because of the changes to the domestic law, the time limit is actually being lifted. Next slide. So a question, can arise as to whether, is it possible to go for arbitration, since arbitration is now being included in several treaties. So is it possible to go for arbitration if a decision has been rendered by a court or tribunal in Singapore or in a foreign jurisdiction? So Singapore has basically opted into the mandatory binding arbitration, but with the reservation that unresolved issues from an MAP case cannot be submitted to arbitration if a court or tribunal has already issued a decision. And if the arbitration proceedings have commenced, but the decision has not been delivered, and the taxpayer seeks legal remedies through the court, the arbitration process shall also terminate if the court has issued a judgment. So there could also be situations where before the court issues a judgment, the arbitration, has already delivered their judgment, right? Now, so when we look at some treaties like the Singapore-Australian Treaty, that has the mandatory binding arbitration provision. In those cases, the taxpayer has to, within 60 days, actually withdraw, withdraw from the courts, right? But if they choose to continue with the court, then the issue would be that the arbitration outcome may not actually be binding. Next slide, please. So here are the 5 broad steps in the MAP process as outlined by the Singapore Tax Authority. Now, step 2, with regard to the first pre-filing meeting, this is only applicable in transfer pricing cases. So if it is a non-TP case, basically there's no pre-filing meeting. Now, in terms of the review and negotiation process, the Inland Revenue aims to resolve MAP cases within 24 months. Now, based on the results of the peer review, for non-TP cases, the average time to close a case in the period from 2016 to 2018 is about 20 months. TP cases take a little longer, about 28 months, right? So TP cases slightly more than 24, non-TP cases fall below 24. On an average, we are looking at resolving a case in about 25 months. So these are the statistics provided through the peer review. But it is noted that Singapore has allocated additional resources to accelerate the closing of MAP cases within 24 months on the average. Next slide, please. Now we look at the new tax treaty between Indonesia and Singapore that incorporates the MLI provisions on BEPS Action 14.
We have 1 minute to go, Pastor.
Okay. Next slide, please. So if you look here, what really stands out is that Indonesia has not, opted in, or rather opted out of applying the arbitration articles. So there is no further recourse for a taxpayer if there's no satisfactory resolution of the dispute through the MAP process. As you know, MAP article, do not generally compel the competent authorities to reach an agreement, but only to use their best efforts. So therefore, there could be situations where, there is no MAP agreement between the two countries. So without arbitration, there'll be reduced tax certainty. Next slide, please. Now, under the new tax treaty, Article 9, Para 2 has been introduced to deal with the issue of economic double taxation. The point I want to make here is that neither Indonesia nor Singapore is obligated to make a corresponding adjustment just because the other country has made a primary TP adjustment. The OECD the OECD commentary says that state is committed to make a corresponding adjustment only if it considers that the adjustment made by the other state is justified. So it would end up in a consultation between the competent authorities. Now, from a Singapore perspective, the Inland Revenue is unlikely to make a corresponding adjustment outside the MAP. So this means that the taxpayer has to go through the MAP process, and therefore Article 9 is not going to operate on its own outside the MAP process. Next slide, please. Secondary adjustments. Now, the TP adjustment made by a tax office is a primary adjustment. But this does not alter the fact that the excess profits represented by the adjustment are not consistent with the result that would have arisen if the controlled transaction had been undertaken on an arm's length basis. So secondary adjustment is included to ensure the actual allocation of profits is consistent with the primary adjustment. So we know that the Indonesian Tax Authority does make secondary adjustments. Now, as far as Para 2, Article 9 is concerned, it does not deal with secondary adjustments. It does not forbid nor recommend secondary adjustment. So in this case, effectively, Singapore can refuse to grant relief in respect of a secondary adjustment made in Indonesia. But having said this, I think the general view is that a secondary adjustment could be dealt with through the MAP process. That is, if the primary adjustment is reversed, the secondary adjustment should be reversed too. Next slide, please. So here, just doing a very broad comparison of the MAP article in the old and the new treaty. the thing is that the first three para in the new and the old treaty, right, very much have this, the same key elements of the MAP provisions in Article 25 of the OECD Model Tax Convention. So with the MLI, there were not like a significant change to the MAP provisions. So if you can see, some of the highlighted provisions, like the case must be presented within 3 years. Any agreement reached should be implemented, notwithstanding any time limit. So this has been in the old treaty, and it's the same continues in the new treaty as well. Okay, next slide.
I think we have run out of time.
Okay, so finally concluding thoughts, right? So in this slide, I've just put some, possibly some advantages. MAP process can be faster, depends on the country's court processes. But given that, the BEPS minimum standard does encourage countries to stick to an average time frame of 24 months, it's possible that MAP process could be faster than a court process, right? The other thing is that, double taxation may not be resolved through the court process because, a country is not obligated to accept the judicial outcome in another country, whereas MAP process, two competent authorities are working together to resolve the double taxation issue. Other salient features, no cost to MAP. Both Indonesia and Singapore do not charge taxpayers, so that's a good thing. But of course, there could be costs incurred in engaging consultants and so on, but it could be cheaper than engaging lawyers and going to the court, right? Both Indonesia and Singapore have established MAP processes, regulations and facilities, and therefore, that would really help a lot as well. Now, despite some of these advantages, I think MAP is still not popular to resolve disputes. MAP cases in Singapore is still modest, although it could be on an upward trend. MAP cases in Indonesia is more than in Singapore, but it's much lower than, I think, disputes brought to the court. So perhaps taxpayers are not well informed, despite the fact that both Indonesia and Singapore tax authorities have issued guidance on MAP. From a Singapore perspective, the ability to reach audit settlement with the tax authority can also diminish the need for MAP. So perhaps with more awareness, more taxpayers over time may consider MAP as a means to resolve cross-border tax issues. So this brings me to the end of my presentation. Thank you very much. Sorry, Bu Zahra, I overrun a little bit.
Thank you, Pak Siva. Interesting, and thank you for highlighting some important features of Singapore MAP operations. And you also mentioned about related corresponding adjustments and mandatory binding arbitrations. And from the numbers shows that Singapore has a relatively small number of MAP inventory. And also the last slide, you said that Singapore and Indonesian MAP process steps are similar, and probably it's because with the adoptions of international practice. So before we go to the questions, please, you still have time to type them into the question box in your Zoom control panels. And now we come to our last speaker, Pak Cindy. Pak Cindy, though actually no need for introduction for you, but let me briefly read your CV, Pak Cindy. Pak Cindy has over 20 years of experience as a tax consultant and with extensive experience in serving multinational and large national clients from various sectors, including energy resources, manufacturing, consumers, and service company. Pak Cindy also involved in various work for the restructuring, M&A, tax audit, and dispute resolution process. Cindy is a tax leader and MMA tax specialist from KPMG, and Cindy graduated from Agriculture Engineering of IPB University. And over to you, Pak Cindy.
Sure, thank you, Bu Zahra. Just a revision, I'm in Deloitte, Indonesia.
Oh, sorry, yeah.
Okay, can we go to my slide, please? Okay. Thank you. So first of all, good afternoon to Pak John, Pak Pontas, and IAI Committee, Ibu Dwi, Pak Siva, and Pak Graham, and all panelists. Also very good afternoon to Bapak Ibu participants. I'm very happy to be one of the presenters today to discuss on the international tax aspect related to the RUU HPP. As it was earlier mentioned by Bu Dwi, the RUU has one new article in relation to the tax collection assistance. This tax collection assistance is very, very specific and brand new in Indonesian tax system. Firstly, before I go through some important points about the new KUP, Article 20A, please note that the content of my presentation material is based on the version of the RUU HPP. The content may still further change. Some of the information in the slide are also based on the academic paper of the RUU KUP. Therefore, we still must refer to the final version of the law and the relevant implementing regulation, which will be issued by the government. Now, let's go to page 3 to start a high-level study together about this new article. There are 9 paragraphs in the new Article 20A. From paragraph 1, we can learn that the MOF is authorized to cooperate for the implementation of the tax collection assistance with other countries. Paragraph 2 stipulates the Director General of Taxes will be in charge for the implementation of the tax collection assistance. Indonesia can provide tax collection assistance to other countries, and on the other hand, Indonesia can request for assistance to other countries as well. The paragraph 3 highlights a very clear statement that Indonesia will implement tax collection assistance on the basis of reciprocal treatment between Indonesia and the other country. Now, who are the countries that Indonesia will cooperate for tax collection assistance? The paragraph 4 defines that country is a country of a jurisdiction bound to the Indonesian government by an international agreement. Then, next page, please. Then what kind of international agreement specifically considered for these procedures? The paragraph 5 defines 2 specific international agreements, the DTA or the treaty or the P3B, and also Konvensi tentang Bantuan Administratif Bersama di Bidang Perpajakan. I understand this is basically the Convention on Mutual Administrative Assistance in Tax Matters or MAC. From the remaining 6, paragraph 6, 7, 8, and 9, basically, we learn a new terminology called as tax claim. Basically, the tax claim is a legal instrument which will be used by Indonesia as a basis to provide assistance to other countries in order to collect tax in Indonesia on behalf of such other country. I presume that the same mechanics will be applicable for Indonesia. I mean, Indonesia also need to prepare tax claim to be submitted to other countries to request for the assistance. Further detailed procedures about the tax claim may be stipulated by an implementing regulation issued by the MOF. Another important point here is paragraph 8 about how Indonesia will assist tax collection procedure in Indonesia, where it is specifically mentioned that Indonesia will perform the collection procedure with surat paksa that apply mutatis mutandis with the applicable collection procedures in the other country. Next page, please. Now, it is also good for us to understand the background so we can learn about the reasons for the new edition of Article 20A. We generally understand globalization makes it harder for tax authorities to perform the collection of tax. Taxpayer may have assets throughout the world, but the tax authorities generally cannot go beyond their borders to take action to collect taxes. We understand from point number 1 that Indonesia believes it has potential tax amount to be collected. However, the taxpayer or the tax bearer is outside of Indonesia. We further learn that Indonesia direct collection action on the asset located in other country can be considered as violation of the territory of other country. For this reason, an international agreement for assistance in the collection is very important. Applying this international tax cooperation concept, Indonesia must enter into international agreement to enable Indonesia to request for assistance for tax collection. The last point, number 3, we learned that it is also required for a country to make adjustment to its domestic tax law to enable administrative procedures as stipulated under the international agreement to be applied within the Indonesian tax administration system. Specifically, in relation to this point number 3, this means that the tax collection assistance could be effective only if both countries have entered into international agreement and also both countries' domestic laws also allow the reciprocal tax collection assistance procedure. Next, in page 6, I would like to mention again here, there are 2 types of international agreement mentioned in the RUU. Indonesia is also one of the signatory countries for MAC, which also regulate tax collection assistance. However, Indonesia takes a reservation position at this moment because the domestic law has not accommodated for this procedure. It is expected that in the future, with this new Article 20A, Indonesia can change its reservation position. The other type of international tax agreement is the tax treaty. From the academic paper, we understand that Indonesia has 13 treaties that includes the tax collection assistance. You can see the 13 countries as mentioned in the slide. Let me remind you again about the point number 3 in the previous slide, that in the context of the tax collection assistance, it is also required for a country to make adjustment to its domestic law to enable the international agreement provision. It will be therefore important to know whether or not the partner's country domestic law is also ready with the implementation of this tax collection assistance procedure. Now, let us learn some sample from 13 treaties to understand how the tax collection assistance arrangement in the specific way. On page 7, this is the tax treaty between Indonesia and US. As you can see, the treaty with US clearly supports the tax collection assistance procedure. But one interesting point to highlight here is about the wording to ensure that any exemption or reduced rate of rate shall not be enjoyed by a person not entitled to such benefit. Does this mean that only very specific type of income tax assessment that can be requested for tax collection assistance procedures? This is an interesting point related to how this limitation on the type of taxes will interplay with the tax collection assistance procedure. The paragraph 2, I think we can generally interpret it is required for both countries to make any necessary adjustment to the domestic laws to accommodate and enable the tax collection assistance administrative procedures to be applied. This is in line with our earlier discussion. Next page, on this page 9, the sample is the treaty with Belgium. This treaty also looks very, very similar with the treaty with US. Next page on the Netherlands. The next 2 sample here are treaty with the Netherlands and India. We will see these 2 treaties are quite different from the US and Belgium treaty. Under the Netherlands treaty, please note a highlight that the subject of tax collection assistance is not restricted to the tax resident of Netherlands and Indonesia only. Also, the type of the tax is not restricted to income tax only. The claim means amount owed in the respect of tax of every kind and description. Please note that Treaty with Netherlands also specifically clarifies the status of the tax amount owed based on legal instrument that is not contested. So next page, page 10 is with India. Basically, this is quite similar with the treaty with Netherlands. So basically, we observe from the 4 samples of the tax treaty that the arrangement under each tax treaty could be also different from one to another. Therefore, the tax implication on tax collection assistance can also be different from one to another. Next slide, page 11. This is in relation to the new terminology of tax claim. As we know, there are various types of legal instruments for Indonesia to collect underpayment tax amount. There are SKPKB, SKPKBT, STP, and so on, as mentioned in this slide. I think it is reasonable to assume that the tax collection assistance will be based on any legal instrument in Indonesia which is not in dispute process. For example, it is common that we see a tax assessment may be disputed through tax objection, tax appeal, and finally tax judicial review. We hope that a further guidance will be stipulated in the relevant implementing regulation to confirm about this matter. Another important and interesting point to be further observed is in relation to the Indonesian concept of penanggung pajak or tax bearer. Just to give you a context that an example in Indonesia, taxpayer in the form of limited liability company, based on the prevailing KUP law and also PMK 189/2020, the definition of penanggung pajak will include directors, commissioners, certain type of shareholder, and so on and so on. The interesting point is to observe if this specific concept of Indonesian penanggung pajak will be acceptable or not by a country requested by Indonesia for the tax collection assistance. So we learn.
Time is up, Cindy.
Just a minute, sorry. We learned previously that generally the tax collection assistance shall require procedures to be consistent with the domestic law in other countries. Last slide, please. I think this is my final slide. Basically, we learned several important points from the new article about tax collection assistance. Number one, Indonesia Tax Authority can seek international cooperation with other countries based on the applicable international agreements related to tax collection assistance. Number two, be more proactive in the tax collection procedures, even though the asset of taxpayer or tax bearer are not located in Indonesia. Number three, hopefully from this new article about tax collection assistance, Indonesia can get indirect benefit in the form of better voluntary compliance level from taxpayer or tax bearer in relation to the tax settlement. So this is the end of my presentation. Thank you for your time and attention in learning together about this new tax collection assistance procedure. Usahra, now I pass over the time to you to proceed further from here. Thank you, Bu.
Thank you, Pak Cindy, and thank you for sharing how Indonesia has an intentions to collect potential tax across its jurisdictions. And how requests for assistance, I think, play its role as a legal requirements for these collections. And you also mentioned about some requirements from international perspective that we have followed main international practice, including signatory of mutual assistance in tax matter or MAC. And we have installed some provisions under the prevailing tax treaty agreements. And thank you for all presenters. And I think now it's time to take some questions. Can we have, can someone help me to show some questions here? Sorry, I can't. All right, thank you. So this question is, Ibu Dwi, apparently you are so famous here, Ibu, the racing star in the sessions. And from Anak Agung Gede Sila Astungkara. Nowadays, internationally, there are trend for MAT, which is, we know that it was on the draft of the bills, but it was been taken out. And then on the other hand, Indonesia giving many tax incentive for the taxpayer, super reduction tax. In my opinion, it will be unproductive for Indonesia government to adopt MAT since it will erode the tax incentive regulations. And then number two is, I want to know if there is any plan for our government to give a carbon credit for taxpayer, not only imposing carbon tax for industry, which is producing things that substitute the carbon producing. And for example, incentive for electric car that will eventually replace the internal combustion car that emitting carbons.
Thank you for the questions. For the first question regarding the alternative minimum tax, as everybody knows that it is omit from the draft, and then we don't reach any approval actually from the parliament to impose the alternative minimum tax. So in our opinion at that time, actually this alternative minimum tax is not for, I mean, it is imposed to the certain taxpayer that filed the negative profit of income or negative profit for many years. Actually, it is many companies like that in Indonesia who file the tax return with report the negative profit for such period of time, maybe more than 10 years. But in fact, the company is still going stable. They still can expand their company in Indonesia. But then again, within the discussion, that this is not approved by the parliament, and then we reached the conclusion that we not impose the alternative minimum tax. In terms of the incentive, yes, indeed, there is many incentive also being introduced to Indonesian government to the many companies or many certain industry or particular industry in this case. But since the alternative minimum tax is not past the parliament discussion, so I think we still maybe in certain cases, in certain clue, in certain sector, we still introduce in the incentive. That is the first answer, and then the second regarding the carbon tax. Yes, indeed, it is in the regulation. We introduce or we impose the carbon tax is only for the certain industries. In this case, the electricity companies who use the coal, turbine coal, I mean. So this is for the first phase, and then the second phase it will be introduced on 2025. But in what objective, in what area, or in what industry is not yet being what I can say, being decided. So still many things to discuss, still many things to be considered, and I think your input for this is very precise. And then I mean, yeah, I will pass this input to our regulation team, that maybe there is later on that there will be incentive for electric car that will eventually replace the internal combustion car. I think it is a good idea also. But it will be imposed, as I mentioned earlier, it will be imposed in 2025, because for the first implementation now is only for the particular company that, for example, for the electricity company that used turbine coal for their productivity. I think that's it, the answer for the second question from Pak Agung. I return back the time to Ibu Zara.
Thank you, Ibu. I think times doesn't permit us to go over to the questions, but the last question that you answer is first, don't worry about the AMT, it's been taken out. And then second is it's a good, thank you, Pak Agung, for the carbon tax mechanisms, and it will be applied, like we said, on stages depending on the industry sector. And it looks like we have covered all. And for these occasions, I would like to express my appreciations to speakers, Ibu Dwi, Pak Graham, Pak Siva, and Pak Cindy, for your valuable contributions to these sessions. It is an honor to have you with us, Pak and Ibu. And our deepest gratitude also to all of the participants that also hoping this session will improve our mutual understandings to the draft of law and also informative. So this concludes our sessions, and thank you again for joining us today, and looking forward to seeing you in the 2022, which is next year's ITC conference. Stay safe and vigilant, and over to you, Ibu Monica.
Thank you very much, Ibu Zahra, for hosting this fruitful session. I would like to also thank you to Ibu Dwi Astuti, Mr. Graham Garvan, Bapak Cindy Sukiman, dan Mr. Sivakumar Sarafan. What a very fruitful discussion. I would like to invite all of you to have a group picture. So all smile. We will have our team to do the screenshot. Okay, all smile. I'll count to 3. 1, 2, 3. Another group picture. 1, 2, 3. Thank you very much, ladies and gentlemen. Ladies and gentlemen, move on to our last panel discussion for the ITC 2021. We will discuss more about the taxes challenges arising from digitalization. As the panelists, we will have Bapak Arnaldo Purba, Section Chief for Exchange Information 1, Directorate of International Taxation DGT Indonesia. Also, we will have Ibu Melanie Dwi Astuti, Assistant Deputy Director Fiscal Policy Agency, and Bapak Bawono Kristiaji, Partner Tax Research and Training Service DDTC. As the host, we will have Bapak Sundi Fitris, Partner RSM Indonesia. Okay, ladies and gentlemen, I would like to also remind you before we commence the session, if you have any question, please use Q&A function, and our moderator, Bapak Sun Fitris, will choose your question and ask the panelists to answer your question. Without further ado, I would like to hand over this session to Bapak Sun Fitris. The screen is yours, Pak.
Yes, thank you, Monica. Good afternoon, everyone. The Honorable Chairman of Institute Indonesia Chartered Accountant. And then for Tax Accountant Compartment, Bapak John Hutagal.
Thank you, Pak.
Masih mute ya?
Hello? Clear, Pak. Clear.
Oh, okay.
Your voice is clear.
And then the Honorable of Speakers, distinguished participants, ladies and gentlemen, good afternoon. This is the last session, and then as usual, the digitalization is always one of the hot topics because it is commonly attached with our activities, or I would say in our lives. I would have thought that most of us are aware that digitalization has been attached with our lives or our activities. You realize it or not, or you try to ignore it, but it happens. The instances that you can see and may have experience on that you do online shopping, whether it is goods or digitals, such as games, that for a millennial, they know about Mobile Legends and PUBG Battlegrounds. even software. You can download it or purchase it digitalized online or on digital system. And then the transaction, whether it will relate to domestic transaction and or cross-border, and then even include online subscription, you will experience that. You will experience that as well. Online registration, digital documentation, even e-signature. That a lot of some of the provider actually for e-signatures, not only for domestic but also from the overseas. And then if the overseas, actually most of them, and many of them carried out by multinational enterprises that do not reside in Indonesia. And then we also know that we do actually on daily basis in regard to the tax compliance, that our tax compliance now managed on online basis. Even we report to the Director General of Taxes through e-filing, that actually saving time and then ease our life. And all of them is growing rapidly. So let's explain the brief that earlier that there will be discussing about the topic that relate to transparency and taxation and digital business transaction, which are transaction via electronic system, or we know it as perdagangan melalui sistem elektronik or PMSA, that those are carried out by multinational enterprises that do not have physical presence in Indonesia, but apparently don't no need for them to be present in Indonesia. And then the government actually that has issued certain regulation. One of those is Perpu number 1 year 2020 that has been validated as a law according to the law number 2 2020, that the VAT has been imposed, that appointing the multinational enterprises to become a VAT collector, and it would be easy, I believe, administration for them actually to conduct because they are not Indonesian tax resident. And then so far there have been 81 companies appointed as tax or VAT collectors. But now the question is that, how about the income tax or pajak penghasilan? So we thought further delaying that, please welcome our distinguished speakers, Bapak Arnaldo Purba, or Pak Aldo, Ibu Melanie Dewi Astuti, Bapak Bawono Kristiaji, or Pak Haji, to share their thought or their valuable thoughts during this session with the topic of the taxes challenges arising from digitalization. So the first speaker will be Pak Aldo, and then please allow me to read a short CV of Pak Aldo. Pak Aldo, current position is Section Chief for Exchange of Information 1, Director General of International Taxation at the DGT. And then he started his career after graduating from STAN. And then Dr. Aldo commenced work for Indonesia Tax Authority directly. So after 14 years services, Dr. Aldo left to pursue his master's degree at Waseda University in Tokyo, Japan. And he was then awarded an Australia scholarship, which allowed him to complete his PhD in the Research School of Accounting between July 2014 to July 2018. Then Dr. Aldo returned to Indonesia and continued working for DGT. And he has worked in a wide range of areas, including international cooperation and tax treaty division, and the international exchange of information. Then, Pak Aldo, the time is yours, and then you have 15 minutes, Pak, to share your thoughts, please.
Thank you, Pak Sanfitris, for your kind introduction.
Ako, Pak, you can call me Ako.
Or Pako. I thought I have 20 minutes, but it's actually 15, yeah, Pak. So I may drop one slide or two along the way. Okay, allow me to also say hello and thank you to Pak John Hutagal and the team for making this event possible. Good afternoon, all participants and all my colleague, other panelists, Bu Melanie and Pak Haji. If someone from your side, Pak Ako, can share screen my presentation deck, that will be, thank you.
Yes.
Yeah. So Last year in the same conference, same session actually, I talked about the conceptual framework of taxation of the digital economy. Today, I'm very happy to be a panelist of this session because I have a chance to update you with the current progress of the topic. But rather than talking about the concept again, I think it is now the time to focus more on the technical issue, which is what do we get really from the consensus of the digital economy taxation? I know I have only 15 minutes, so yeah, next slide, please. Taxation of the digital economy has been a main issue of international tax, at least for the last 2 decades. But it was not until July 2013 when the OECD released a report titled Base Erosion and Profit Shifting, or BEPS Action Plan, that taxation of the digital economy came to be viewed by many as a serious issue. In 2016, the OECD G20 Inclusive Framework on BEPS, or Inclusive Framework, or simply IF, was established. Indonesia is also a member of IF. Ever since, the discussions of taxation of the digital economy involve not only developed economies, but also developing nations. The main challenge of the digital economy is that businesses can operate in a jurisdiction without being physically present in that jurisdiction. Unfortunately, according to the existing rule, a jurisdiction can only tax business profit derived by a foreign business if it has a permanent establishment, or PE, in that jurisdiction. But as we all know, the current rule requires a physical presence of the foreign business to have a PE. So the inclusive framework has conducted many meetings, long meetings, to address the issue. Initially, it was expected that a global consensus to be achieved last year in 2020, but it didn't happen. However, IF kept trying. More meetings were held. The last meeting was actually 5 days ago. Therefore, time-wise, our conference today is held perfectly because I can include some updates from the meeting in my presentation. Next slide, please. So in July this year, 120 IF members agreed upon the so-called 2-pillar solution to address the tax challenges arising from the digitalization of the economy. Pillar 1 is expected to update international tax rules into the 21st century. This can be done by offering, market jurisdictions new taxing rights over multinational enterprises, whether or not there is a physical presence. And the name of the new tax is Amount A. Pillar 2 provides a minimum tax on corporate profit to backstop tax competition by a minimum level of taxation wherever an MNE operates. Next slide, please. The OECD has conducted a research on the economic impact of the 2-pillar solution, including the additional tax revenue. Last month, David Bradbury, the head of the Tax Policy and Statistics Division of the OECD's CTPA, stated that Pillar 1 and 2 could increase global corporate tax revenue by about $150 billion per year. This is equivalent to about 2,000 trillion rupiahs. Yes, it is huge, but again, the question is, do we get a slice of the huge cake? Sorry about the announcement from my office. If yes, is the slice of the cake small or big? So to answer those questions, we need to understand the elements of the solution. Next slide, please. So there are 13 components of Pillar 1 agreed by the inclusive framework. By considering the time constraint, I will include only 6 of them. So first, scope. Multinational enterprises will be in scope if they derive global revenue above 20 billion euros and profitability above 10%. The global revenue threshold can be reduced to 10 billion euros after 7 years, depending on the success of its implementation. Also, regulated financial services and extractives are excluded. Second, nexus is the key to determine whether a jurisdiction qualifies for the amount A allocation. Finally, stop. It was agreed that the nexus is 1 million. Still the previous slide, please. Yeah. It was agreed that the nexus is 1 million euros, but for jurisdiction with small GDP, the nexus is 250,000 euros. Indonesia will definitely use the 1 million euro nexus. Third, 25% of residual profit will be allocated to market jurisdictions. And there are some more components, but I will skip to save some time. So next slide, please. So at this point, you might get confused, but I hope that this slide can explain better. So first, so this is the illustration to get amount A. So first we look at the global revenue and the profitability of the M&E. Are the global revenue above 20 billion euros and profitability above 10%? If the answer is no, the M&E is out of scope. If yes, proceed to the next step. Is the M&E running business in financial service or extractive sector? If yes, the M&E is out of scope, meaning no amount A from that M&E. If no, we need to look at the revenue collected from the country. If the M&E collected less than 1 million euros, no amount A allocated to that nation. If at least 1 million euros revenue derived from that country, the country should look at whether the M&E has a subsidiary or a permanent establishment. If no, then it has the right to get amount A. If there is a subsidiary or a PE, the country needs to make sure first whether the residual profit are already taxed in that jurisdiction. If the amount paid is equal to or more than the amount A, then there will be no additional tax revenue under amount A for that jurisdiction. But if the tax paid is less than amount A, the jurisdiction is entitled to get the discrepancies under amount A schema. Next slide, please. So I may need to skip this one because it actually it's similar to the previous slide. So next slide, please. So as I have mentioned earlier, the revenue threshold of 20 billion euros is indeed extremely high. For illustration purposes only, Nintendo, a large Japanese multinational consumer electronics and video game company, collected global revenue of more than 15 billion US dollars and profit of more than 4 billion US dollars. So while the profitability threshold is met, I think it's more or less 25% of its revenue, the global revenue threshold doesn't meet. So as a result, Nintendo is out of scope, meaning the large company is not required to pay amount A. I do not have the data of the revenue collected by Nintendo in Indonesia, but I'm sure that the products, both the game consoles and the video games, are familiar to the people of Indonesia. Other examples, MasterCard, eBay, the two leading multinational enterprises that may not be subject to amount A because the global revenues are below the threshold of 20 billion euros. Next slide, please. You may think that why don't we apply Indonesian law number 2, year 2020, as it is the legal basis for income tax or electronic transaction tax on e-commerce, as Pak Ako just mentioned. It also stipulates significant economic presence provisions. Well, taxation on e-commerce, including the significant economic provisions, will not applicable until the government further regulates in a government regulation and finance minister regulations or the implementing regulations. But I think that is not the main reason for not imposing the unilateral measure. The main reason is, I think, is in the next slide. So next slide, please. So the main reason, I think, is due to the fact that Indonesia is committing to the support for the international collaboration to address tax challenges from digitalization. As we have seen in the previous slide, one component of Pillar 1 statement, even though I did not elaborate that component, is the removal of any unilateral measures. So next slide, please. If you look at the worldwide proliferation of unilateral measures, according to a KPMG's report, until recently, 26 jurisdictions have enacted unilateral measures. However, note that, like Indonesia, enacted does not necessarily mean implemented. In particular, when the enacting countries sign the multilateral convention, their unilateral measures are likely to be removed and will not be implemented. Next slide, please. So, from my explanation, we now can identify that the proposed solution contains at least 3 issues. First, there has been a shift from the initial purpose of focusing to the taxing the digitalized business to taxing the largest companies. As you can see, the scope component of Pillar 1 only touches upon the 2 thresholds, global revenue and profitability, and does not mention at all about digital or non-digital. Second, on the removal of DSTs and other unilateral measures, it is not crystal clear as to whether jurisdictions cannot apply their unilateral measures on out-of-scope M&Es. Some countries, such as you remember in one of the IF meetings, UK and Italy have declared that they will remove their DSTs once the consensus achieved. But other countries, including Indonesia, are still waiting for clarification from the OECD. Last but not least, Indonesia may need more than 1 year from signing the multilateral convention to the implementation stage, because ratifications usually need about 2 years. Next slide, please. To wrap up, this is going to be my last slide, I think, Pak Ako. Do we get a slice of the big cake? Yes, but the chance will be bigger if the global revenue threshold is lower and the percentage allocation of residual profit to market jurisdictions is greater. Not to mention, there will be a long way to get the slice of the cake, as I have shown you in my one of my slides. Do we get a small or big slice? Well, it depends on several elements, such as the size of the revenue that the in-scope M&Es collected from Indonesia, the level of profitability of the M&Es, and for in-scope M&Es that have subsidiaries or PEs in Indonesia, taxes already paid is a determining factor as well. Considering the factors and the very limited number of M&Es that will be in scope, I am of the view that the size of the cake might not be as big as we expected. Lastly, what about Article 6 of Perpu 1 2020 as ratified by Law number 2 2020? our commitment to global consensus requires us to remove, any unilateral measures later on. As I mentioned earlier, Italy and UK have done it. So I think there is very little chance that we can further regulate Article 6 of Perpu 1/2020 to tax out of scope MNEs. Next slide, please. Yep, I will stop here. Thank you, everyone. Back to you, Pak Ko.
Thank you, Pak Aldo, for the insight. This is very thoughtful and valuable. So what I pick up is that it is really a long experiencing discussions between all of the countries involved. And then this Pillar 1 and Pillar 2 are triggered by this erosion profit system, which makes sense. And then because that's actually that, what is that? It's like an abuse on any tax planning on that. At the moment, tax collection system is still according to the physical present, but by opening up the discussion, so without physical present also it's possible to be taxed in the certain jurisdiction, and potential increasing of income tax globally about $150 billion per annum. But the thing is, this is about the allocation of the fairness that may become a question. And residual profit allocation is 25%. So therefore, Pillar 1 measures are based on global revenue plus profitability may not achieve the fairness expectation. Indonesia still, of course, support and commit with international collaboration. That, as Pak Aldo said, one thing that is interesting, that whether other digital services, other taxes on digital services will be deleted if this concept of tax on the income tax is finally implemented. And then, but of course, if you participants have question later, please just freely write in the Q&A, and then after the three speakers speaks, and then we will have the Q&A session to answer the questions. And the next speaker will be Ibu Melanie. So please allow me to read her CV that explain that Ibu Melanie current position right now is Senior Tax Treaty Analyst, Fiscal Policy Agency, or BKF. Prior to this, she was Assistant Deputy Director for Tax Treaty at Fiscal Policy Agency, Ministry of Finance of Indonesia, and she started her career at the Director General of Taxes Indonesia within 2003 to 2018, 15 years of services. And then completed Bachelor in Accounting from STAN, and obtained Master of International Taxation from University of Sydney, Australia. Ibu Melanie, the time is yours for 15 minutes, ya Bu. Thank you.
Thank you, Pak Ko. Let me share screen first. Is it clear now? Can you see my share screen?
Not yet, Bu. Yes,
not
probably,
yet. Wait a minute.
Yeah, not yet. Yes, it's about to start. Yes, Bu, it is clear now.
Okay. Good afternoon, everyone. Good afternoon, Pak John, other panelists, participants, and the organizers. I hope you all safe and healthy. Today, I will present about the tax challenges arising from the digitalization of the economy. As Pak Aldo has delivered his presentation on Pillar 1, I will focus on VAT and Pillar 2. To save our time, I will proceed. This is my outline today. I will cover VAT, income tax, global agreement, and unilateral measures. But some of them have been covered by Pak Aldo, so I can skip. This is our digital taxation policy. It covers VAT, which is governed in Law number 2/2020 and Ministry of Finance Regulation number 48/2020 and Director General Regulation number 12/2020. It is implemented on July 2020. While for income tax and electronic transaction tax or pajak transaksi elektronik are also governed in Law number 2/2020, but they are not yet implemented. Why? I think Pak Aldo has mentioned the reason why we don't apply these two taxes up until now. Okay, I'll start with VAT. The scope of VAT collection consists of cross-border taxation, which already stipulated in Ministry of Finance Regulation number 48/2020 and the Director General's Regulation number 12/2020. While for the domestic transaction, the government has issued Government Regulation number 9/2020, but I think it still needs an implementing regulation. In the law of harmonization of tax law, I think it's also stipulated about the collection. I can highlight a brief about what is in Ministry of Finance Regulation number 48. The object is intangibles and services, including digital goods and services provided by foreign suppliers or platform to Indonesian consumer through electronic transaction, or Pak Ako has mentioned before, perdagangan melalui sistem elektronik PMSE. The collecting agents are foreign suppliers or service provider, foreign platforms, and domestic platform who facilitates the sales between foreign suppliers or platform and Indonesian consumers. Appointed by the Director General to be a VAT collecting agent. What is the threshold? The threshold is transaction value more than 600 million rupiah per year or 50 million per month, and or traffic number 12,000 per year or 1,000 per month. And this is what I can summarize from the regulation. The scope of VAT is not limited to digital products, products which is provided through electronic transaction. For example, like online gaming, online advertising, cloud computing, and etc. Our scope is broader than that. It covers all services and intangibles as long as it is traded through electronic system. So the products doesn't always have to be delivered through electronic transaction, but the trading should be. The VAT collected at 10%. As you know that our new bill will impose VAT on 11. I don't know whether this VAT will be adjusted to the new rate. Let's see. Let's wait and see. It is applied to B2C and B2B, so the cover is broader than the common practice because the other countries' practice commonly use this VAT mechanism for digital transaction only for B2C, not for B2B, because for B2B there is reverse charge mechanism. The collecting obligation based on appointment rather than mandatory or voluntarily. So even though the threshold has been met by the foreign platform or suppliers, if Director General has not appointed them as VAT collecting agents, so they are not obliged to collect VAT from Indonesian consumers. The registration, collection, payment, and reporting system are simple and can be done electronically. Doesn't have to register for tax identification number. Invoice is required but simplified. And the last, having local agent is not mandatory. That's what I can summarize from the Ministry of Finance number 48. OECD has published international guidelines, 2 guidelines with regards to VAT on digital transaction. If we compare between the guidelines and the Ministry of Finance regulation, they are aligned. There are only minor difference. For example, if the guidelines recommend the the use of VAT simplified registration for B2C only, our Ministry of Finance regulation adopt the broader approach. It is applied for B2C and B2B. That's the difference. Okay, and if we see the other countries' practice in collecting the VAT from digital transaction, there are more than 100 countries have adopted this simplified registration system, and commonly referring to the OECD guidelines. The summarize commonly applied to digital products. So it is only applied for products delivered provided through electronic transaction. And then some countries use threshold while others not, like India. India doesn't introduce a threshold, but in our regulation, we use the threshold. The tax rate is more than 10%. So our rate, 10%, is considered low. The common practice is for B2C, because for B2B, there is reverse charge mechanism. But with regards to Ministry of Finance number 48, we apply both for B2C and B2B. And having local agent is mandatory in some countries. Okay, this is for VAT collection on cross-border. And now I will look at what we have for VAT collection on domestic transaction. A long time ago, we issued Ministry of Finance regulation number 210. Actually, it's not a long time ago because it's 2018, but it has been revoked for some reason. But in 2020, the government issued the government regulation number 9/2020. It stipulates that VAT could be collected from digital transaction by a third party, but it still needs an implementing regulation. So just wait and see. I have covered the VAT, and now I'll go to income tax or direct tax. Okay, this will be divided in three parts: the existing regulation, unilateral measures, and global agreement. This is our current regulation based on income tax law and tax treaty. Profit derived by foreign resident from the sales of goods and services to Indonesian consumers could only be taxed in Indonesia if there is permanent establishment. Meanwhile, the permanent establishment concept is still referring to physical presence. The profit allocation is still referring to arm's length principle, or in the income tax law, it is in accordance with the Article 5. For digital economy, the permanent establishment could be a fixed place like office, warehouse, branch, server, or dependent agent PE, which is dependent agent, and service PE, the provision of service in the source country for the period exceed the time limit, the time test. Okay, next. This is what we have in law number 2/2020. I think I don't have to explain a lot about this because Pak Aldo has covered about this. These two taxes, you adopted the significant economic present approach. However, due to the inexistence of implementing regulation to define what significant economic present is, the threshold, so they cannot be applied up until now. That's and why I think Pak Aldo has explained. Okay, and now I arrive at the unilateral measures. There are many forms of unilateral measures applied worldwide. Some of them are significant economic presence, which is adopted by Israel, India, and Nigeria. Equalization levy, which is adopted by India. Diverted profit tax, UK and Australia have implemented this. And last, the most common unilateral measures adopted worldwide, digital service tax. I think Pak Aldo has also conveyed about the other countries' practice on applying the DST. I only take some of them. It's about 15. The common rate used is 3% or 5%. However, due to the global agreement it reached in July 2020, and 132 out of 139 countries, and in October now is 136 out of 140. Zambia joined the inclusive framework. So now 4 more countries joined from the July. Based on the global agreement, as Pak Aldo mentioned, each country who has adopted the DST or other relevant similar measures have to stop collecting the DST. They don't have to revoke the regulation now, but they cannot collect the DST from 8 October 2021. So for Indonesia, it's no problem because we haven't implemented anything. We have the regulation, we have enacted, but we haven't implemented the regulation. Okay, next slide. We are now in the global agreement. I have mentioned that it has been joined by 136 countries out of 140. Pillar 1, Pak Aldo has explained about this. I don't have to touch on this. Pillar 2, it is aimed to address the remaining BEPS issues and other than digital economy, which has been covered by Pillar 1. It is prevent the profit shifting, the BEPS risk, by introducing a global minimum tax of 15% tax rate. To ensure that MNE pay at least 15% tax through the application of subject to tax rules, STTR, income inclusion rules, and under tax payment rules. Okay, I will go further on the detail. I don't have to explain this. These the building blocks. There are 13 blocks, but to save our time, I will not touch all of the blocks. This is the rule design. So Pillar 2 will have 2 interlocking domestic rules. The IIR and UTPR are domestic rules, so it should be adopted in the domestic regulation to be applied. And then a treaty-based rule subject to tax rules. The STTR should be included in the tax treaty to be applicable. These are the globe has hierarchy. The first in the hierarchy of the implementation is STTR. STTR is a treaty-based rule. It will restore taxing rights to the source state relevant to intra-group payments, for example, like interest, royalty, and other defined set of payment like franchise fee, like rental, that exploits certain provision of the treaty in order to shift profits from source countries to jurisdiction where those payments are subject to no or low rates of nominal taxation. For example, the rate is different from the UTPR and IIR rate, which are 15%. The STTR rate is 9%. So, for example, if Indonesia, as a source country of an interest paid to other countries, if such income is taxed under the STTR minimum rate under 9%, Indonesia could impose additional tax until 9%. This is what STTR is. And then the IIR. IIR will give right to the resident country of the parent to impose top-up tax until 15%. It's similar to CFC, and it has priority over UTPR. And the last measure is UTPR. UTPR only applies if the parent country doesn't apply IIR. UTPR requires a taxpayer to make an adjustment in respect of any top-up tax that is allocated to the taxpayer by denying a deduction. So the rate is the same between the UTPR and IIR, but the mechanism is different. If we see, Pillar 1 may be more beneficial for market country like Indonesia because it provides new tax. We can tax the income of the digital businesses or broader scope, large MNEs, even though there is no physical presence. But for Pillar 2, I don't see it's the same. Pillar 2 tends to benefit developed countries. because as you can see, the IIR give the rights to the parent country. As we know that the UPE, ultimate parent entity, is mostly domiciled in developed country. In Indonesia, the number is not very big, so I don't think we can get significant tax revenue from Pillar 2. Okay. For the implementation, Pillar 2 will be signed in 2022 and then effectively implemented in 2023, but UTPR will be postponed until 2024. Yeah, I don't think this is what is fair, because UTPR and STTR is more beneficial for developing countries and IIR is for developed countries. But the UTPR will be postponed. The implementation of UTPR will be postponed to 2024. And for STTR, there are so many exemptions. The covered income is narrow, and it only covers intra-group payments. Okay, I think that's my explanation on Pillar 2. I will not touch on this because I have delivered this before. The scope is limited to MNEs whose consolidated turnover more than 750 million euros, similar to CBCR threshold. There are also excluded entities, government entities, international organization, non-profit organization, pension fund, and others. And there is also other exclusion, which is international shipping income.
Sorry, Bu, 3 minutes left.
Yeah. Okay, I think I can finish with 3 minutes. This is my example on Pillar 2, especially the IIR. If we can see, as we can see in the picture, Starco is resident in the US. It is parent company. It has 2 subs in Indonesia, PT Star, and in Ireland, Star Limited. In Indonesia, the ETR is 20%, while in Ireland, the ETR effective tax rate is 12.5%. In this regard, based on Pillar 2 or GLOBE, US can impose top-up tax 2.5% in relation to Star Limited because the ETR is below the 15%, the global minimum tax. While with regards to Indonesia, there will be no top-up tax that can be imposed because the ETR is above the 15%. That's one of the example of the application of IIR. The Pillar 2 also provides substance-based carve-out. So it will provide a formula substance carve-out that will exclude an amount of, income that is 5% of carrying value of tangible asset and payroll. In transition of 10 years, it will be increased to 8%. So I'll give you an example. PTX is a member of X group which has UPE in the country X. PTX is eligible for a tax holiday of 100% CIT in country X. If the total expense on depreciation and payroll are 400,000 and the substance carve out is 5%, we can see in the table, carve out 5%. The carve out will be calculated 5% multiplied by 400,000, which is 20,000. So this 20,000 will be subtracted from the GLOBE income, which is 200,000. So in this regard, the tax saving that can be enjoyed by investor only 3,000. It's not very, it's very small compared to the 100 carve out, which is 44,000. This is why Pillar 2 will have significant impact on the design of tax incentive. As can you see in the picture, if Indonesia apply tax holiday, so the ETR is 0%, the resident country will impose 15%. The benefit is not going to the investor, but to the resident country. That's I can deliver today. Thank you.
Thank you, Bu Melanie, very thoughtful presentation. So yeah, before we move to Pak Aji. So yes, as Ibu Melanie said, VAT, and we have been aware of that the VAT has been imposed, and there is no new system there, but probably new there is no new substance on the VAT, but it's only probably a new mechanic for the VAT for B2C arrangement. And the government regulation number 9/2020 also provide clarity on the transaction for PMSC or transaction via electronic system, because if the end user or if the buyer or the recipient of the goods or services is the end user or end customers, so that is considered as well pedagang eceran or retailer, because before that it is not clear whether the online or the e-commerce companies are considered as a retail company or not. And then yes, even though it's a pending regulation on that. And for the VAT on the for the MNSC, multinational enterprises, it is still open for the reverse charges or self-assessed. And then yeah, and then it is also interesting that the explanation by Ibu Melanie to linkage between the local rules to the global agreement and the unilateral measures. And then for the income tax, that Pillar 1 has already been discussed earlier with by Pak Aldo, and the Pillar 2 still is addressed based on the pricing or BAPs, based on private safety. And then it is according to the global minimum tax rate. And then interestingly, that big multinational enterprises may pay at least minimum level of tax, but yes, subject to tax rule or FCTR. And then the next step will be income inclusion rule, and then also the under tax payment rule or UTPR. But the interesting one is that if, according to the Melanie, if I'm not mistaken, that STTR also that may need actually tax treaty provision. I mean, the concept need to be included in the tax treaty provisions. And then this is also a debate, because initially Paulo said that Pillar 1 may not give full benefit on allocation, even though the potential global revenue increase. But the Pillar to give more benefit to developed countries, which is not that fair to developing countries. And then, but it seems that the Pillar 2 to be implemented, brought into the law in next year in 2022 to be effective in 2023, and then UPTR will be later in 2024. Yes, this is a really an interesting debate because the party is not only one, but also involves many countries, so many jurisdictions with that whole discussion. I know that, that each government, I believe, protect their own interest. So now we welcome Pak Aji as the last speaker. And before we start that, I would like actually to read this short CV. Organizer, please present. Yes, Pak Bawono Kristiaji, or called in short Pak Aji, he is a partner of Tax Research and Training Services at Dhani Darussalam Tax Center, or DDTC. He is an experienced practitioner in public finance, tax policy, and transfer pricing. He is also an active member of Indonesian Fiscal Association, or AEFI, and Indonesian Fiscal and Tax Administration Association, IFTAA. Earned his bachelor degree in economics of the University of Indonesia, and then obtained master degree in international business tax and economics from School of Economics and Management, Tilburg University, the Netherlands, under scholarship from the corporation where he's working now. Adani Darussalam Tax Center. Pak Aji, the time is yours, and then feel free to present, and then for 15 minutes, ya Pak.
Okay, Pak. Thank you, Pak Akop. Good afternoon, ladies and gentlemen. Good afternoon to my colleague, the other speakers, Pak Aldo and Bu Melanie. Also, I would like to send my warm regards to Prof. John. Thank you, Pak, for this opportunity. Well, sorry, can somebody from the committee share my presentation on the screen? Yeah, well, we already heard about the Pillar 2 and the Pillar 1 and Pillar 2. Pillar 1 is from Paldo, already mentioned about that, and also Bu Melanie already explained about the Pillar 2. Today I will share my thoughts and present insights about the two-pillar solutions, or probably I would say the dark side of the two-pillar solution. Okay, probably next slide, please. Well, first of all, I would like to invite to all the participants to understand the context of the two-pillar solution, because it is important to understand the context in order to assess the implication and also the future impacts of this global consensus into the Indonesian taxation. Well, first, as Pak Aldo already mentioned before, previously, that there is a long history or a long discussion about how to get a multilateral solution on how to taxing the digital economy. But again, I would like to highlighting that although the title is digital tax problem, on the two-pillar solution, we knew that this is not only deals about how to tax the giant digital technology companies, but also the winners of the globalization. So if I'm not mistaken, based on the last year proposal, OECD only the scope of the Pillar 1 especially is only for the automated digital services companies and also the consumer facing business. But on the last proposal, we know that the scope will be the all companies with the global revenue above the Euro 20 billion. And also, besides on introduce the new nexus on the taxing rights and also how to give like or how to elaborate the significant economic presence. It also introduced the new formula for allocating the profit of the multinational enterprises. And also the pillar, especially the Pillar 2, also have, I would say, the ambitious task on how to on how to stop the tax competition trends by introducing the global minimum tax. And all the other important lessons is related to the political economy process. So, for instance, during Trump's administration, US didn't agree and tried to postpone the global consensus. Well, again, this is typical of the inward-looking policy under the Trump's administration. But there was a turning point when the Joe Biden took place. So after the Joe Biden took place, US endorsed and promote the two-pillar solution. I believe these moves was merely to protect the US interests, since they want to increase the corporate income tax rate from 21% until to 28%. So they try to ensure their competitiveness in the global economy, especially at the post-pandemic economic recovery. And also the political economic motives could be seen on how determine the threshold and the carve-out. Carve-out is the exception. As Pak Aldo and also Bu Melanie already mentioned before, the threshold is a critical point on how much the pie or the slice of the pizza will get by Indonesia and also other developing countries. And also, for instance, the question is whether why the threshold on the pillar 1 and 2 are different. What is the argument? I don't know until now. And on the third point, this is the typical, the global OECD proposal on two-pillar solution is the typical of the supranational tax rule that should be ratified first domestically before implemented. And all the countries which agree should follow this new international tax system. And so therefore, there are three implications on this kind of multilateral solutions. First, there will be no room for unilateral action, and also UN bilateral solution. As for information, that UN previously released new article, which is Article 12B as the bilateral solution on digital taxation through the withholding tax scheme. So there is no room for unilateral or bilateral solution based on the UN suggestion. And the second one, there will be new administrative and law complexities to ensure that the domestic regulations in line with such multilateral solution. And the last one is the fiscal sovereignty for each countries, of course, will be reduced. And finally, we should note that this two-pillar solution is proposed by the OECD, endorsed by the G20, and discussed via BEPS inclusive framework. Well, the question is why the OECD? I will leave this question to all the participants. Okay, next slide. So now we discuss about the pillar 1 and try to understand and try to reconstruct why the pillar 1, the formula on pillar 1 is as mentioned by the last proposal last week. Well, first of all, the pillar 1 is try to find a solution because the new taxing rights, because it starts with the problem of the digital economy, as Pak Aldo already mentioned, Bu Melanie also, that the digital economy companies can get income from source jurisdiction without physical presence. So there is no taxing rights give to the source jurisdiction. So therefore, from the beginning, there was a critical urgency or critical question to find and define the so-called significant economic presence. The question is what will be the new nexus? So if we try to look on the BEPS project, action 8 to 10 regarding on the transfer pricing and the value creation, well, basically all the allocation of based on those documents, basically all allocation of the fair share of profit and taxation and should be aligned with the value creation within the global value chain. So if we try to connect this term, the value creation, with the significant economic presence, I think there is a relative a connection in this term. The second one, if we talk about the international tax reform on the corporate income tax, there are some academics propose that the corporate income tax in the future should adopt the destination-based taxation, just like a VAT. It means that the taxing rights should be given to the jurisdiction that record as sales or where the consumption is took place. So if we try to connect why the significant economic presence also try to there is a threshold on the revenue, this is probably the connection. So because there is an alternative paradigm moving towards the destination-based principle. And regarding on the allocation of the taxing rights, we should notice that Aldo already mentioned clearly about the 25% of the residual profit will be defined as profit in excess of 10% of revenue will be allocated to the market jurisdiction with nexus using revenue-based allocation key. So if we solve this kind of or type of the solution, we can see also this source revenue rule under the Pillar 1 is somehow similar to the residual profit method in the transfer pricing. Whereas the amount A is the non-routine function and the amount B is a routine function. Please note that the profit split method was considered as the perfect transfer pricing method. But also, it creates a complexities and challenges to calculate on and how to allocating a profit across the jurisdiction. Okay, next slide. Okay, this probably this slide is very interesting slide to the government, especially government in developing countries. So based on the OECD documents released last week, it said that under Pillar 1, the taxing rights on more than 125 billion US dollar of profit are expected to be reallocated to the market jurisdiction. So this is a good news for Indonesia that we always related the market jurisdiction to our jurisdiction as we have like large of population, large of user participation, and so on. But the question again, is it true that we can have the large slice of pizza? Well, I will would like to compare the statement of the OECD with the statement from the IMF based on their publication, Digitalization and Taxation in Asia, probably released in last month. So according to this publication, the emerging economies such as India, Indonesia, and Malaysia may lose about 0.01% of GDP in revenues, or at least have a modest revenue gain. But the larger share of the gain will be get by the China, Australia, Japan, and Korea. So again, there is still a question whether this Pillar 1 will be beneficial to Indonesia or not, from the perspective of the revenue impact. Okay, next slide, please. This is from the administrative consideration. When we talk about the administrative consideration, I would like to recall about our domestic regulation on the Perpu number 1/2020. I believe that this kind of regulation is
3 minutes ya Pak Haji.
Sorry?
3 minutes left.
Okay, this regulation is a preventive regulation to prevent any disagreement on the global consensus. But again, after the Indonesian government already agree with the Pillar 1, the government should abandon, or at least should not release any secondary or implementing regulation on this. And furthermore, from the administrative side, there will be a risk of double taxation, I believe, because by this the Pillar 1 will reformulate all profit and taxing rights. So in this case, there should be an effective international tax dispute resolution. But again, if we look through the MAP, Statistic Mutual Agreement Procedure Statistics released by the OECD this year, well, although the effectiveness is getting better over time to resolve the international tax dispute is still more than 2 years. So how can the tax certainty and also how to have like the effective dispute resolution is in line with the implementation of the Pillar 1. Probably I will have to go to the next slide because the time is running up. Next slide, please. So this is about the GLOBE rules. This is about the Pillar 2. Well, basically, I definitely agree with Bu Melanie already mentioned that it seems that the global anti-base erosion as an element in the Pillar 2 consisted of the IIR and UTPR will give a benefit to more to the developed countries, because we know that the GLOBE itself, the IIR, is implemented as per the perspective of the resident countries, not the source countries. So if the capital exporting countries seen that any investment in other countries taxing the business under the 15% of their effective tax rate, capital exporting countries could tax the residual. So, and if we saw the criterion of the income inclusion rule, we know that the jurisdiction can tax the residual if the headquarter reside on the jurisdiction, no matter if the threshold is under euro 715 million or not. So it seems that the GLOBE rules have a tendency to give benefit to residents or headquarter companies. Again, the main issue in the Pillar 2 is from the perspective of the benefit of the Indonesia is how we can still have a competitiveness under this Pillar 2, because as Bu Melanie already mentioned, how the future of our tax incentive roadmap and also how I'm afraid that this is only a tool to facilitate the repatriated income to residence countries. Okay, next slide. Okay, probably this is from the administrative perspective. I believe in this case on the Pillar 1 and Pillar 2, the information is very important and very critical. So therefore,
I'm sorry, Pak Aji, time is up.
Yeah, in the future, the country by country reporting is more critical and more important to ensure the effectiveness of the Pillar 1 and 2. Probably I will stop and will let Pak Akop to sum up my presentation today. Thank you very much.
Yes, but thank you, Pak. It's very thoughtful, very unfortunate because the schedule has been extended. So, and then we have a Q&A session. So yeah, what did I pick up actually that the explanation from Pak Aji, which is one actually very interesting to me, that value creation, which is related to the sales or consumption, that indicate to the significant economic presence. And then, yeah, and then for the Pillar 1, still as initially explained by Pak Aldo and Ibu Melanie, seems does not really in favor to the to Indonesian, because not only Indonesian would face this unfavorable outcome, also India and Malaysia may lose about 0.01% of GDP in revenue, or if there is any gain, probably it's only modest revenue gain. And that for high-income countries like Australia, Japan, and Korea, they will enjoy actually more benefit. Even with the large markets like China, they will enjoy more gain revenue on that. So, but the thing is, on the other side, some of developed countries like Singapore and Hong Kong may lose also the potential revenue 0.15% GDP revenues because of the market actually is not big, even though they are categorized as developed countries. And then Pak Aji also mentioned that interestingly that Perpu number 1 year 2020 as validated by law number 2 2020 has anticipated OECD consensus, but the challenging still calculation and administration, and then also Pak Aji also touched based on whether it requires a CDCR or country by country report in relation to the exchange of information. Pillar 2 is end up with the global minimum tax rate, as Ibu Melanie and also Pak Aji mentioned that the developing countries may concern on that because of the subject to tax rule concept. While if it is UPTR is applied, then probably that helpful, but it is postponed or delayed. So this is actually we have to appreciate the effort by the government in order to obtain consensus. Because, for instance, like VAT, it has been successful to be imposed, although probably it's not optimized yet. But as an end users or end consumer, we cannot actually deny that the VAT is subject to is based on the consumption basis of if the price of the enjoy increase by 10%, that is actually the compensation that we need to consider whether we wanted to buy or something. But now actually, if you look at the level playing field, it is not fair if the gigantic multinational companies dealing with the digital transactions, because there's no physical operation, they still enjoy. I mean, they would not require to pay tax in Asia. So jurisdiction shopping like tax haven countries is still open for them, which is if the investors come to Indonesia. So the investor may feel what happened with us, we pay, we comply, but the other parties have luxury on that. So yeah, this is actually very important, not only for the revenue of Indonesia, but actually to achieve level playing field. And then without delaying, so probably from the participants have questions, so they address to the panelists or to the speakers. Yep, I can see that. Yep. So why don't Director General of Taxes just imposing final income tax for the overseas digital economy company that obtain income from Indonesia, just like final income tax for foreign shipping company under Article 50 and 19 income tax law? Yeah, maybe Pak Aldo, Ibu Melanie, and later Pak Aji, would you please share your thought on this? Yeah, why not? We have a sovereignty, right? We have independence as negara yang berdaulat. Please, Pak.
I can try to address this question, and maybe later on, Bu Melanie, Pak Aji, of course, can add some more. But yes, you're right, Pak Ana Agung. Yeah, that's one option. But I think that's also like other options. It is also a challenging one. Yeah. So I think when it comes to income tax or the like means including this final tax, yeah, on cross-border transaction, we have to really consider. One of the considerations would be the interaction between our domestic regulations and tax treaties, for example, right? So this also applies to international shipping and transport, right? So as you know, one of the articles in the Model Tax Convention is about this, international shipping and air transport. So that's one thing that we need to look at. And the other thing I think is that we might need to look at how other countries react to this policy. We have seen how the US respond to DSTs all over the world, including to our Perpu 1 2020. So yeah, so many things that we need to consider. I think it's not that simple, but yes, it is one option. Maybe Bu Melanie and Pak Aji can add some more. Thank you.
Thank you, Pak Ako. I think Pak Aldo explanation is quite clear. I just want to add some detail, a little detail maybe. Well, as Indonesia is one of the countries joined the global agreement, one of the 136 out of 140. So we have commit not to impose income tax with regards to digital economy especially. Income tax is tax on net income or income tax substitute. Final tax deemed income, which is governed in Article 15, is also income tax. The expense is deemed to be a certain percent. That's income tax, but not DST. DST is not income tax. That's just like turnover tax. But the party who has to pay is the foreign supplier or platform, not the consumers, different with VAT. That's why we don't impose any income tax or the like, just like Pak Aldo mentioned before, because it will contradict with the global agreement and the current tax treaty. The tax treaty is still based on physical presence. When there is no physical presence, we cannot impose any income tax. Thank you.
Can I add something, Pak Ako?
Yes, of course, Pak Aji, please.
I believe, why not? Yes, that's probably the most important question on this session. Well, but I also agree with Pak Aldo and Bu Melanie, but I would like to add something that first of all, the final tax is simpler. So its administrative feasibility is more feasible to administration. But again, when we talk about the final tax, usually this is the burden of the tax will be passed through to the consumer. So there will be a welfare loss in this case. So in the end, I believe the question is whether could we get revenue from this kind of tax? But on the other hand, there is a welfare loss from this kind of final tax. Probably that is my comment. Thank you, Pak.
Thank you. So there is a barrier about international consensus, unfortunately. But if you look at from level playing field, it's not fair, to be honest. Only for the matter of income tax, for the VAT is still being imposed, and then the system and the mechanic is there. So yeah, if there is no any further question from the participants, so I return the time to the organizer, to the EIE, and then thank you very much, Papa Aldo, Ibu Melanie, Papa Aji, for your valuable thought on this, on the topic. And then I do trust that it's of benefit not only to me, but also to the participants. Thank you very much.
Thank you.
Thank you, Pak Ako, for delivering the helping and assisting the last sessions of our event. As moderator, Pak Ako, thank you. And then I would like to extend our gratitude to our speakers, Ibu Melanie Dwi Astuti, thank you, Bu, Pak Arnaldo Purba, and also Pak Aji, thank you. It's very good presentations, even though it is the last sessions, but I think your presentation is, 2 thumbs up, ladies and gentlemen. So again, thank you very much. Thank you. And hopefully your participation is really something that memorable. And then next year we can meet again, Bu and Pa, and to discuss another issues related to a very interesting topic of digitalizations. Thank you again, ladies and gentlemen.
Thank you, Pa Edward. Thank you.
Thank you.
Thank you all.
So without further ado,
thank you.
Without further ado, I think I'd like to invite Professor John Hutagaol as the chairman of tax compartment of IAI to deliver his keynote speech, or should I say his closing remark to note that our today's event is at the conclusions, and hopefully there's something that that everyone can enjoy and obtain from the benefit. So I'd like to pass the monitor to Professor John Hutagal. Thank you. Pak John, monitor is yours.
Ladies and gentlemen, very good afternoon. Praise to the Lord Almighty God. Now we come to the end of the conference. It is my pleasure to deliver closing remarks on the 8th International Tax Conference held by the Tax Accountant Compartment of the Institute of Indonesian Chartered Accountants, together with BVD, Moody's Analytics, which is started since 12 to 13 October 2021. And for this annual conference agenda, we discuss about the new era of global tax transparency that has been discussed smoothly and interested. The 8th International Tax Conference involved Vice Minister of Finance, who presented about the tax policy reform dealing with the current economic condition affected by COVID-19 pandemic, and many resource persons from regulatory body such as Directorate General of Taxes, Fiscal Bureau Agency of Minister of Finance, and also Inland Revenue Bureau of Malaysia, and professionals from various institutions and organizations, either overseas and locals. At this moment, allow me to express my appreciation and say thank you very much to all speakers, moderators, and other parties that have provided full support and contribution for the successful of this conference. The global tax transparency is needed by the international community to cope with the disruptive impact on transformation of international tax landscape is triggered by the advance of ICT, information, communication, and technology. Furthermore, the advance of ICT have affected on both administration and policy of the revenue administration from most jurisdictions. In dealing with the current global tax matters arising from digital, this needs the international agreement, cooperation, and collaboration. Nowadays, most jurisdictions work together to discuss and look for the global consensus to cope with the global tax matters, such as exchange of information for the tax purposes, taxation on digital product, transfer pricing, and dispute settlement through mutual agreement procedures. Another tax matters arising from the COVID-19 pandemic has a disruptive effect on most aspects of the human life, including the economy and business. Ladies and gentlemen, this annual International Tax Conference has been conducted for the 2 consecutive days and 5 panels discussions with the interesting topics, namely, first, the effect of COVID-19 pandemic and macroeconomics and business. Second, transfer pricing and implementation. Third, the current development of exchange of information. Fourth, international aspect of the law drafted of the tax regulation harmonization. Fifth, tax challenges arising from digitalization. Those above panel discussion have run smoothly and interested, then give enlightened to all of us. Many information and insight arising from discussion in every single panel discussion. Again, thank you for all resource persons and moderators. Ladies and gentlemen, to end my closing remarks, I wish to apologize for all participants if any wrongdoing happened during the conference that make you feel unhappy. We hope we could improve the quality of the next conference. Without further ado, I would like to close the 8th International Tax Conference and hope to see you all again on the next conference. Keep safe and healthy in a new way of life. Thank you. See you next. Bye-bye.
Mantap Pak, udah pre-recorded ya. Iya.
Thank you.
Prof. John.
Thank you for all, Margaret.
Thank you very much Pak Makbul.
Thank you, Pak John.
Ada di sini. Hai
Thank you, Pak
Makbul.
John. Sehat selalu, Pak.
Ya.
Thank you, Pak John. Sehat selalu.
Thank you,
Thanks,
Pak
Pak
John.
John.
Terima
Ya.
kasih IAI, terima kasih Pak John.
Thank you,
Terima kasih,
Professor
Pak.
John Huta Gaul, for delivering the closing remarks for International Tax Conference 2021. Ladies and gentlemen, we would like to kindly inform you to obtain the presentation material of our 2 days conference and give us a feedback to improve our next event. Please to visit the link stated on the screen. To obtain e-certificate, you could also click the link provided on the screen or on the chat box. Ladies and gentlemen, thank you for attending the International Tax Conference 2021. On behalf of IAI, also, we would like to express our sincere gratitude to our sponsor, who also the co-organizer of the conference, Bureau van Dijk, a Moody's Analytics company. We would like to also thank to all the speakers for their informative insight, as well as the participant for taking your time to join our 2 days conference. I'm Monica Nabilia. Thank you. Stay safe, stay healthy. See you on another event. Good evening and bye.
Thank you.
Terima kasih. Thank you so much.
Terima kasih.
John dan tim, terima kasih Bu Monica.
Oh, Margaret.
Ya,
Marigato
Kiso,
Kiso, ya.
Pak Kiso is here.
Oh,
Pak John,
Kiso.
Pak Kiso,
Kiso.
Makbul is here.
Thank you very much.
Growing and evolving based on the decisions you make.
Thank you, John.
You take.
And
Chartered accountants
send
have
my
the
regards and
to
thank
ethics
you
and
to
global
Professor
expertise
Madriasmo as
to
well.
help your business
I
thrive.
will. Yeah,
We
thank
are
you,
uniquely
Kiso.
experienced to make
Keep
a
safe.
difference to your world.
Yeah,
Choose
stay
a difference
safe, keep
maker.
well,
Choose
and
a
hopefully we
chartered
can see you
accountant.
in person soon.
In
Yeah,
Bali.
Thank you.
Yeah, in Bali.
In Bali,
Yeah.
Hopefully
2022.
next year,
Yeah,
no
we do
COVID
event in
anymore.
Bali.
Ya. Pak Angko,
Interesting.
keep in
Ya,
touch
Pak.
ya.
Thank you, Pak.
Thank you very
Pak.
much.
Thank you,
Terima
Pak
kasih, Pak
Kiso.
John.
Thank you, Pak Ko, Pak John.
Thank you, Pak Edward.
Edward,
Thank you
thank you
all.
very much.
Terima kasih.
Umar,
Kenal,
Pak
salam
Bagus,
kenal.
thank you. Pak Arnaldo.
Thank you.
Paham.
Terima
Terima
kasih
kasih.
IAI.
Take
Iya.
care, everyone.
Thank
Stay
you.
safe, stay healthy.
Bye.
Bye-bye.
Now, have a good
Bye. Mohon
have
izin
a good
ya.
day. Have a good night.
Ya,
Oke,
bye-bye.
Bye bye. Bye bye.
Keep safe. Bye.
Bye.
Okay, ladies and gentlemen, thank you for joining our today's conference. I would like to close this Zoom webinar room on my 3. 1, 2, and 3.